So guys, are we live? Are we live? Are you ready? Are you ready? Good morning, sir. Good morning, never stop the beat. I guess Monica it is if I'm not mistaken. Please confirm, can you all hear me? Can you all listen to me? Can you all see me? Whether audio video is clear to all of you or not. Audio video is clear to all of you? Audio video is clear. Okay, audio video seems okay. Just give me a second. Huh? Okay, Ji. So, hello everybody, and welcome to the CA Final Direct Taxes and International Taxation live power batch, that too in full English. I hope you all are doing really, really well. Meanwhile, you tell how you all are doing. Let me make you revise what we have studied yesterday. So, we started off with understanding what was the premise of the power batch yesterday. Then we came on to certain basic definition, which was SSC. Who is a person? Who is SSC? Any individual, HUF, AOP, BOI, artificial juridical person, any company, any firm, LLP, and local authority is a person. Then we came on to previous year. Sir, what is previous year? Previous year is the year in which income is earned. We understood that. And assessment year is the year in which income is taxed. Okay. Then we came on to general tax rates. Sir, for individual HUF, AOP, BOI, artificial juridical person, general tax rates under old tax regime is as follows. Try participating it with me. I know it is difficult to participate in morning, but the more you participate, the more you learn. Sir, individual HF, AOP, BOI, artificial juridical person are being taxed at up to 2.5 lakh no tax, 2.5 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, more than 10 lakh 30%. If he is a senior citizen plus resident plus individual, in that case, up to 3 lakh no tax, 3 lakh to 5 lakh 5%, 5 lakh to 10 lakh 20%, more than 10 lakh 30%. And if you are super senior citizen, then in that case, up to 5 lakh no tax, 5 lakh to 10 lakh 20%, more than 10 lakh 30%. If your total income is up to 50 lakh rupees, no surcharge. 50 lakh to 1 crore, 10%. 1 lakh to 1 crore to 2 crore, 15%. More than 2 crore, then you have to do the bifurcation. How bifurcation is done? Sir, whatever the cap gain income is, dividend income is, that has to be considered separately and surcharge 15% on that income. Others income, if it is up to 2 crore, then 15%. More than 2 crore, up to 5 crore, then it is 25%. Up to more than 5 crore, then it is 37%. And 4% education cess is always added. If you are a firm, local authority, and LLP, flat 30% tax rate, and if total income is more than 1 crore, then surcharge at the rate of 12% is applicable. If you are a company and you are a foreign company, then 35% surcharge, sorry, 35% tax. And if you are a domestic company and your turnover is up to 400 crore in previous at 2024, then 25% tax, else 30% tax. What is the surcharge? See, for domestic company, foreign company, total income up to 1 crore, no surcharge. 1 crore, 10 crore, 7%, 2%. More than 10 crore, 12%, 5%. For a cooperative society, if your total income is up to 100, then 10%, sorry, 10,000, 10%, 10,000, 20,000, 20%. More than 20,000, it is 30%. And surcharge as domestic company would apply to cooperative as well. We understood the example as well. Sometimes what happens is your income increases by a slight amount, but taxes increases so much. In that case, you are given a marginal relief. We understood how do we get that. Then we came on to a concept of rebate 87A, which talked about if you are resident individual and your total income is up to 5 crore rupees. In that case, what would happen? You are given a relief amounting to rupees tax payable or 12,500, whichever is lower is the relief that you would get. Remember, whenever you consider tax payable now, never add education cess in this, and you will never get relief on income taxable under 112A, that is listed equity shares, long-term capital gain. You would never get rebate in that case. Apart from that, if your income exceeds even by a rupee, then rebate is not available to you. Yes, sir, we came on to capital gain. Where we started with charging section, where we understood what is charging section. Any gain arising from transfer of capital asset shall be taxable under that capital gain in the year in which transfer took place. This is what we started. For that matter, we understood the definition of the capital asset. Sir, there are three kinds of assets which are capital assets. First of all, any asset is a capital asset, but stock in trade, movable personal assets, rural agricultural land, and gold deposit bonds are not capital assets. But if you have any jewelry, drawing, painting, sculptures, archaeological collection, any other form of art, bullion, these all shall be considered as capital assets only. In addition to that, if FIIs or AIFs hold any securities in India, then such securities are always capital assets. In addition to that, if you have any unit linked insurance policy, these are all capital assets. Then we came on to definition of rural agricultural land. We understood that a land which is not urban is rural. Now, what is an urban land? For that matter, you have to check the municipal limits. If there is a municipality, municipal corporation, or cantonment board, whatever area this municipality is, so that is always urban. And if population is 10,000, then that area is only urban. But if population is more than 10,000 up to 1 lakh, then 2 kilometers beyond the area of this municipality shall also be urban. If population is more than 1 lakh up to 10 lakh, then population beyond 6 kilometers, the municipal limits shall also be urban. And if population is more than 10 lakh, then area beyond 8 kilometers area from the municipal limits shall also be urban area. Then we came on to the definition of transfer, where we understood any sale, any exchange, any relinquishment, any extinguishment, any conversion, any compulsory acquisition, any transfer of asset, any transfer of immovable property on account of giving over the possession, any redemption of zero coupon bond, and any transaction which has impact of enabling you to enjoy the immovable property, everything shall be considered as transfer. Then we came on to type of capital asset, where we understood that if you have long-term capital asset, you will have long-term capital gain. If you have short-term capital asset, you will have short-term capital gain. How do we decide it is long-term or short-term? For that matter, you have to check the period of holding. For listed equity shares, for listed securities, for equity-oriented mutual funds, for units of UTI, for zero coupon bond, you have to check 1 year of period of holding. If it is held for more than 1 year, it is long-term. Less than 1 year, it is short-term. For every other asset, you have to check for 2 year of for period of holding. Then we came on to capital gain computation, where we understood the format. Full value of consideration minus transfer expenses will give us net consideration. Reducing cost of acquisition, reducing cost of improvement will give us the capital gain. How do we arrive at full value of consideration? We have a simple provision. Whatever the money received or receivable to us is nothing but full value of consideration. But we have three special considerations. First of all is section 50C, which says that if you sell any immovable property now, if you sell any immovable property, that is land or building, remember, if SDV exceeds 110% of consideration now, then SDV shall only be consideration. But if SDV does not exceeds, then whatever actual consideration is shall become the consideration. Done, sir, done, sir, done, sir. If I am not satisfied with SDV, what do? I shall go to assessing officer. Assessing officer will refer the case to valuation officer. Valuation officer might increase, might decrease. If he decreases, we will take the reduced one. If he increases, we will ignore his SDV. Which SDV we have to take? Registration date or agreement date? Ideally, we should be taking the date on which you received the money via account, paycheck, demand draft, electronic clearing system. If you sell any unquoted shares, then FMV or sales price, whichever is higher, shall be taken as FMV. But these provisions are not applicable for the companies whose board of directors have been suspended by the central government. 50D. How do we determine the Full value of consideration where sales price is not determinable. Just take FMV in that case. Then we came on to cost of acquisition. Important section. Important section. Whatever the price you have paid to acquire the asset, that is the cost of acquisition. Whatever the direct expenses you incur, that is also added to cost of acquisition. But STT is never added. In addition to that, if you have taken deduction of any expenditure under any head, it might be 24B, it might be chapter 6A. If you have taken deduction of any expenditure, that will not be added to cost. But if any expenditure has been incurred to obtain the clear title of the asset, will that be added? Right answer is yes, it will be added. Sir, we understood 4 cases. If asset has been acquired on account of exempt transfer, then we will take the cost of acquisition of the previous owner. Second thing, if asset has been acquired long back, in that case, we get a benefit of 1st April 2001 FMV. Sir, if we have any intangible asset and such intangible asset is self-generated, we will take nil. If it is acquired, then purchase price. Then we came on to depreciable asset. If we have a depreciable asset, we shall take WDV. Apart from that, we understood that for intangible assets also, we might take WDV if such intangible assets are part of block. And on intangible assets, FMV benefit as of 1st April 2001 is not available to us. Can you all relate to what we had studied yesterday? Were you able to recall? Good morning, everybody. Were you able to recall? Hmm? Beautiful. Sir, in a revisionary batch, you are revising what we had revised yesterday. Wow, sir. So isn't this your duty to share it with your friends as well? Every time, via some or the other manner, you try to come up with sharing. Now, continuing further, cost of acquisition, we are understanding how do we calculate the cost. Basic fundamental is whatever purchase price you have paid, that is the cost of acquisition. But we are understanding the special cases. Coming on to next topic, that is bonus share. How do we determine the cost of acquisition of the bonus shares? See, by default, whatever the cost, whatever the bonus share you get now, its cost is always nil. Always nil. Thumb rule is whatever the bonus you get, cost of acquisition on such bonus shares is always nil. Always nil. This is the thumb rule. But sir, if such bonus shares are very old, it is possible na, that we have got bonus before 1st April 2001, then provision says FME benefit will be given on such bonus shares. What if such shares are being allotted after 1st April 2001 then? Then sir, nil. Take it nil. What if sir such bonus are listed? Can we get benefit as on 31st Jan? Yes, benefit of 31st Jan is available if such bonus shares are listed. So what did I say? Ideally, bonus shares are considered as nil. Cost of acquisition of bonus shares is always nil. Whenever you get bonus, now the share price is divided into multiple parts. But cost is never divided into multiple parts. Cost remains intact. Cost of bonus shares is always considered as nil. If such bonus is acquired before 1st April 2001, then you get a FMV benefit as on 1st April. If such bonus shares are listed, you again get benefit as on 31st Jan 2018. Apart from that, always take bonus share cost of acquisition as nil only. Done, sir. Done, 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 sir. Right share. Right share is a bit logical. Just participate with me. Just participate with me. It's a not okay. Right share. Right share. Okay, sir. For example, Reliance come up with a right share. Reliance is trading at 1500 rupees, and Reliance come up with a right issue that Rahul can buy such shares of Reliance at rupees 1000. I can buy such shares at rupees 1000. Yes, you understand the right is something that I can buy shares at a discounted price. I have a preferential right to buy such shares. Now, if share is trading at 1500 rupees and I have been given right to buy at 1000 rupees, what will be my cost of acquisition? What will be my cost of acquisition? Sir, of course, price paid to company. Price paid to company will be cost of acquisition. So whenever there is a right issue coming and you acquire shares on account of right issue, Your cost of acquisition is price paid to money. But sir, what if I renounce this right? What if I renounce this right? Can I renounce? See, I don't want to buy this share. I don't want to buy this share. I am endorsing this share to Jayashree. I took 100 rupees from Jayashree and now Jayashree wants to buy this shares. Provision says whatever the renouncement money you receive, whatever the renouncement money you receive, Anna, that is always the short term capital gain. That is always the short term capital gain. Whatever the renouncement money you receive, it is always short term capital gain. And for Jayashree, cost of acquisition would be, see, since she paid 100 rupees to me and 1000 rupees to the company, so her cost of acquisition would become 1100. Simple point. Simple point. Very simple point. See, when I exercise right and buy shares, whatever price I pay to the company shall become my cost of acquisition. But if I renounce that right, what would happen? Whatever the money I am receiving now, that shall be considered as whatever the money I am receiving, that shall be considered as short-term capital gain, renouncement money. And what will be cost of acquisition for Jayashree? Whatever price she is paying to me and whatever price she is paying to company, that shall become cost of acquisition. Done, sir? Anybody having doubt in this point? Anybody having doubt in this point? If not, then I have a doubt. If you don't have a doubt, I have a doubt. Will you all clear it to me? Will you all clear? Sir, I'm just asking your general knowledge. What will be the tax rate applicable to this short-term capital gain? Assume that this is Reliance, a listed share. It has offered a right. It has offered a right to me, and I have renounced that right, and I received 100 rupees, and it is short-term capital gain. What will be the tax rate applicable to the short-term capital gain? What will be the tax rate applicable to this 100 rupees? I want you all to think and answer. This short-term capital gain on listed securities. Monica says something. What other people say. Satish says slab. Monica says slab. Right answer is yes, it will be taxed at slab only. Right answer is yes, it would be taxed at slab only. Sir, most people get confused here that this short-term capital gain on the renouncement money of this listed shares is not taxed at 20%. It is always taxed at slab. Why? Because no STT is paid. Beautiful answer, Monica. Beautiful answer. You have not paid STT on this now. You are even not actually selling the shares. You are selling the right to buy shares. You are not selling share. You are selling right to buy a share. For that matter, no benefit of 20% would be given to you. This would be taxed at slab only, irrespective of the size. You would be taxed at slab only. Got it, sir? So this is about right. Now I want you all to answer one question. One beautiful question I want you to answer. Will you answer? Will you answer? Just listen to this point carefully. This is Rahul, and I have been working at Reliance. Okay, I am a very humble, very good employee. Everybody appreciates my work. Because I am an employee, I have been awarded ESOPs. How much ESOPs? See, Reliance is trading at 1500 rupees, and I have got an option to buy Reliance at 600 rupees. And I have got Likewise, 10,000 ESOPs. I have got 10,000 ESOPs. That means how much benefit did I get? I get benefit of 900 into 10,000. That is 90 lakh benefit I have got. Okay, perfect. I worked hard. I worked really hard. And I received these ESOPs. I received these shares and I bought these shares for 600 rupees whose market value is 1500. 1500 is the market value. And because of cash crunch, I sold these shares for 2200. What will be my cost of acquisition? Will it be 600, that is price paid to company? Will it be 1500, that is the uh, market price? Will it be 2200 only? What will be the cost of acquisition for the share that is acquired in ESOP? Share was trading at 1500. I got right to buy such share at 600 rupees and I sold it for 2200 rupees. What will be cost of acquisition for these ESOPs? Will it be 600? Will it be 1500? Will it be 2200? What will be the rate? What will be the cost of acquisition for this ESOP? Beautiful, beautiful logical point. Right now we discuss this thing only. Right now we discuss this thing only. Try participating. And the more you participate, na, the more you will enjoy. I'm saying na, do wrong answers, give wrong answers. I'm there to correct now. For what I am here? If it is a two-way conversation and if you already know the answers, if you already know the correct, you are knowing the correct answer, then what's the need of the batch? The more you give wrong answers, the more there is scope of improvement. Yes, Monica says 600. 600. Yes. What other people say? Jayashri says 600. Satish says 600. Yes. Unparalleled. Dia says 600. Anybody else who want to answer? Sir, welcome to CA final. At least I have some options to, I have something to correct me. Cost of acquisition for ESOP is the FMV on the date on which it is being exercised. Cost of acquisition for ESOPs or sweat equity shares is the FMV of those shares, the date on which you exercise. It is always 1500, not 600. Sir, but you said the price paid to company is the cost of acquisition. Whatever price we pay is cost of acquisition. Arey Baba, I agreed, but I also said na we are studying special cases. Why it is so, I'll tell you. Why is it so? I'll tell you. See, whenever ESOPs are being given, whatever the benefit is there na, in the ESOPs, whatever the benefit is there in the ESOPs, na, this 90 lakh rupees, it is already taxed under salary head. This is already taxable under salary head. Just tell me, if it is already taxed under salary head, and if I take 600 as cost of acquisition, don't you think that there would be double taxation happening on this 90 lakh? If I take 600 as cost of acquisition, there would be double taxation happening. Therefore, we are given higher cost of acquisition benefit because the remaining portion is already taxed under salary head now. So therefore, 1500 would be taken as cost of acquisition. 1500 to be precise, FMV on the date on which option is exercised. FMV on the date on which option is exercised. The date on which option is exercised, now you have to take FMV of that date. Did it add some value to you? Did it add some value? So why you till now you have not liked the video? Just like the video, okay? Because the more you like, it is more reachable. It is reachable to more students. Okay, done, sir. Done, sir. Now we have demerger. Now demerger, I always feel dicey whenever I teach demerger. I always feel dicey. I don't want to tell any formula, any method. I want you to have a pure logic in demerger. Only pure logic is going to work. Any formula is going to be waste of time. Just pure logic. Just participate with me and try answering. Okay. For example, there is a company called Reliance. Why, for example? So there is a company called Reliance. Okay. There is a company called Reliance whose net assets are 1,000 crore and share price is 1,500. But do participate in this point. Now, just because of this point only, I didn't consider this point yesterday. Otherwise, I would have done this yesterday only. I want you to participate. I want you to freshly think of this point. Okay. Net assets of Reliance are 1,000 crore. Share price is 1,500 crore. Out of this Reliance, a small company separated, named Geo Financial Services. Geo Financial Services separated. And with separation, what it took now? It took away the 10% of the assets. 10% of the assets have been taken away by the Geo Financial Services. Yes. Reliance had net assets of 1,000 crore. From there, demerger took place. Demerger took place and Geo Financial Services got 100 crore assets. That means Reliance is left with 900 crore assets. Yes. Yes. In this case, Reliance is called the demerged company. Demerged company, the company whose demerger took place is demerged company, and the newly formed company is the resulting company. Resulting company. Okay. Just answer this with your pure logic that if 10% assets have gone to the resulting company, what would be the share price of the resulting company? If existing company share price is 1,500, what would be the share price of the new company formed? If 10% asset had gone to new company, what would be the share price of the new company? Can you answer that? Sir, if we had 1,000 crore assets and 100 crore assets have been gone to Geo, so if our share price is 1,500, share price would also fall now because net assets have gone to Geo. What would be the share price of the new company? What would be the share price of the Geo? Sir, it is very obvious that since 10% have gone to Geo, 10% would be Geo share price 150. As rightly said, Dia also said this, Satish also said this. So is it very difficult to process? Is it very difficult to process? Just tell me, is it very difficult to process? Sir, I will never understand this point. Of just we cannot even think of this point. What do you do? It is a rocket science. Is it that difficult? Whatever the percentage of assets have gone to the resulting company, that percentage of your share price would also be the share price of the resulting company. No, sir, it is not difficult. Can I say that 150 is the share price of the Geo? So Reliance share price would also fall by 150. That means Reliance share price will now be 1,350. Yes. Yes, yes, yes. Yes. This is only the demerger case. This is the demerger case which people don't understand. Cost of acquisition, shares issued in case of demerger. The shares that are issued in case of demerger. Cost of acquisition of the shares held in demerged company. Demerged company is the Reliance. Reliance shares cost of acquisition is 1,500. Net book value of the asset transferred. 100 crore assets have been transferred to Geo out of the 1,000 crore. That means Geo share price would be 150. This formula says the same thing, does the same logic that you have applied right now. But who is going to learn this? Not necessary. Na. logic is sufficient. If things are clear to you, can I escalate your logic a bit? Can I escalate? Can I escalate? A small thing, a small thing. Okay. Sir, everything remaining same. Everything remaining same in case of demerger. Every shareholder of Reliance received 3 shares of Geo Financial Services. Now, what will be the share price? What will be the share price of Reliance and Geo? Everything remains same. Reliance was having 1,000 crore net assets. 100 crore went to Geo. Reliance was having 1,500 rupee share price. XYZ went to Geo. What will be the share price of Reliance and Geo after this demerger? What will be the share price? Can you all answer? You all agreed. You all agreed that, sir, it is clear to us. We understood the point. Sir, 1,000 crore were the net assets with Reliance. Out of this, 100 crore went to Geo. 1,500 was the share price. So how much would be share price of Geo? Sir, share price of Geo should be ideally 150. But this 150 would be the case if for one share of Reliance, one share of Geo is received. If swap ratio is 1:1, that means for every one shareholder of Reliance, one share of Geo is received, then it would be 150 only. But since one share of Reliance, we are getting 3 shares of Geo, share price would be divided into 3. That means 50 rupees would be share price. And this is the thing that people do not understand at all. This is the basic thing that people do not understand. People tend to multiply it with 3. Despite of studying entire AFM, people multiply it with 3. Are you getting this? Is it clear to you? Whenever the ratio changes, you have to change the share price accordingly. And that is a pure logic. That is, I mean, there can be multiple formulas to solve this, but every formula will not make any sense unless you are not clear with logic. Got it? Clear, sir. What did I say? Whatever the percentage of net assets have been taken away by the resulting company, that percentage of the share price would go to resulting company as well. But if swap ratio is changing, so you have to adjust that share price for the swap ratio. Got it, sir? This is about cost of acquisition. Can you all make it? Can you all recall with me? Can you all recall with me? See, ideally, whatever purchase price you are incurring, that is cost of acquisition. But if any direct expenditure incurred, add to cost. If STT paid, ignore. Any expenditure taken elsewhere, ignore. Any expense paid for clear title, add to cost. If any asset acquired on account of exempt transfer, take the cost of previous owner. If any asset acquired before 1st April, take the cost of acquisition as on FMV as on 1st April 2001. Intangible asset, take the price paid to acquire that intangible asset. Depreciable assets, take the WDV. Bonus shares, ideally take nil, but if you have benefit of FMV, take the benefit of FMV. Right shares, price paid to the company. ESOPs, whatever the FMV as on the date on which option is exercised shall be considered. In case of demerger, for resulting company, what it would be? The percentage of net assets multiplied by the existing share price. In case, in case of, okay, done, sir, nothing left. For all the cases considered. All the cases considered. This is how you consider cost of acquisition in case of capital gain. Always remember these pointers while solving the question. Done, sir? Done with all the important pointers. If you all give me permission, I want to start with special cases. Proviso we will discuss at last only. I want you all to come on to special cases. Special cases require your attention, your full attention for some time. Shall we start the taxation of ULIP? Come on to special cases, that is taxation of ULIP. Whatever book you are following, just take a moment just take a moment and get a screenshot of this chart. Is going to be helpful a lot. Everything that doubt you might have will be cleared. Sir, there is a provision under Income Tax Act, that is 1010D. What this 1010D says, that whatever your sum assured is, if you take any life insurance policy, if you take any ULIP, whatever things you take now, if annual premium of this policy now is more than 10%, it is taxable. If it is less than 10%, it is exempt. Less than equal to 10%, it is exempt. This has been the case. This is section 1010D only, that if annual premium of a life insurance policy or of a ULIP is more than 10% of the sum assured, then it is taxable, else it is exempt. This has been the case scenario. This has been the parlance. Okay. For example, if I buy a policy whose sum assured is 10 lakh rupees and annual premium is say 1.5 lakh rupees. Since annual premium is more than 10% now, it is taxable. This 10% limit was 20% before 1st April 2012, but we don't have to consider that. Just remember 10% today. Provision says if you buy any unit linked insurance policy or life insurance policy, anything you buy, and annual premium on such ULIP or annual premium on such LIP exceeds 10%, 15%, 20% criteria. Remember, ULIP is taxed under the head capital gain and LIC would be taxed under the head IFOS. There is a strict demarcation. Till last year, this ULIP was taxed under IFOS. If annual premium exceeded 10%, now ULIP was taxed under IFOS. Remember, this was the case till last year. This is the amendment in the current year, that if annual premium exceeds 10%, now ULIP will always be taxed under capital gain head and LIC would be taxed under IFOS. Simple point. If you buy any ULIP, if you buy any LIC and annual premium exceeds 10% now, in that case, ULIP would be taxed under capital gain and LIC would be taxed under IFOS. Simple point, no strings attached. 10% premium is the thumb rule. But sir, what if annual premium is up to 10%? If annual premium on that ULIP and then LIP is up to 10%, then what do we do? Listen to this point carefully. Sir, if you have bought ULIP on which annual premium is up to 10%, see, these are special cases. Thoda sa, a bit more attention is required. Okay. If annual premium on that ULIP is up to 10%, premium is fixed up to 10%, then you have to check on what date ULIP has been issued. If it has been issued before 1st Feb 2021, 1st February 2021, if it has been issued before that, sir, it will be exempt on maturity irrespective of your premium quantum. Whatever your premium amount is, if it is within 10% limit, now it will always be exempt. It will always be exempt. But sir, if it is issued on or after 1st Feb 2021, then any ULIP or ULIPs combined together whose premium is up to 2.5 lakh rupees in a year shall be exempt and remaining shall become taxable. And taxable under the head capital gain. What did I say? Just think of ULIPs. Annual premium more than 10%, taxable under capital gain. Less than 10%, check when is ULIP issued. Check when ULIP is issued. If it is issued before 1st Feb 2021, any premium is exempt. But if it is issued after 1st Feb 2021, then ULIP, one ULIP, two ULIP, multiple ULIPs combined together and whose annual premium is up to 2.5 lakh, it is exempt. Otherwise, it shall become taxable. Simple point it is not difficult at all. Let me take one example to illustrate you as to how taxation take place. See, on 1st Jan 2021, I bought a ULIP 1 on which sum assured was 50 lakh rupees. Sum assured was 50 lakh rupees. And annual premium was 5 lakh rupees. First criteria is whether I am fulfilling 10% criteria or not. Whether annual premium is within 10% limit or not, right answer is yes, sir, annual premium is within 10% limit. If it is within 10% limit, just look at the chart. If it is within 10% limit, I would fall under this category. Second thing to be checked is whether it is issued before 1st Feb 2021 or not. Sir, whether it is issued 1st Feb, yes, sir, it is issued before 1st Feb 2021. That means any premium paid, any gain on maturity is exempt, always exempt, always exempt, no strings attached, no strings attached at all. Oh, wow, sir, wow. Similarly, I got some more money. On 1st Feb 2021, I bought another ULIP on which annual premium, sum assured was 12 lakh rupees. Annual premium is 1,20,000 rupees. First thing that you have to do in LIP ULIP is to check the annual premium, whether it is within 10% limit or not, whether it is in 10% limit or not. Sir, is it in 10% limit? Yes, sir, it is 10% limit. It is 10% only. Once it is 10%, now you have to check the annual aggregate premium. If it is up to 2.5 lakh, it would be exempt. If it is more than 2.5 lakh, it would be taxable. And any policy issued before 1st April to the 1st Feb 2021 is to be ignored. For considering the annual limit of 2.5 lakh, now any policy issued before this has to be ignored. Only policies issued after 1st Feb has to be considered. These policies are to be ignored for the limit of 2.5 lakh. Will this be exempt? Yes, sir, this will be exempt now because annual premium is up to 2.5 lakh only. Yes, simple point. Third case. On 1st March 2021, I got some more money. Oh wow, some more money I have got. I bought a ULIP whose sum assured is 30 lakh rupees, whose annual premium is 1.3 lakh. Can I say it is 10%? Yes, sir, of course it is 10%. Of course it is 10%. Can I say annual premium is 2.5 lakh? Sir, this is 1.2 lakh and this is 1.3 lakh. That means overall premium is 2.5 lakh only. So ideally ULIP 3 should also be exempt. ULIP 3 should also be exempt. Done, sir. Done, sir. On 1st April 2021, I got some more money. Oh my God. Oh my God. I got some more money. I bought another ULIP of 24 lakh rupees, sum assured. First thing to be checked, whether are we fulfilling 10% criteria or not? Yes, sir, we are fulfilling 10% criteria. Sir, should this be exempt? For that matter, it depends how much annual premium we are paying. Sir, we are paying annual premium 2.4 lakh rupees. Individually, 2.4 lakh is okay. 2,40,000 rupees is okay. But just wait a second. On 1st April 2021, we are paying 240 for ULIP 4. Don't you think that this ULIP 2 and ULIP 3 would also be required to be paid on 1st Feb and 1st March? That means 1.2 lakh, 1.3 lakh will also be required to be paid. That means annual premium in a year exceeds the 2.5 lakh rupees. Annual premium in this financial year exceeds 2.5 lakh rupees. So here you have to make a choice. What choice you have to make? Sir, you can either take these two ULIPs, 2 or 3 lakh, ULIP 2 or ULIP 3, whose aggregate premium is up to 2.5 lakh rupees. You can claim exemption on these two, or you can claim exemption on this fourth one. You have to take a choice. Whatever ULIPs are up to 2.5 lakh rupees, you can consider exemption on that. Remaining you have to ignore. Remaining you have to ignore. So if you choose ULIP 3 and 4, 4 will be taxable. If you take 4 as exempt, 2 or 3 will be taxable. Choose the most beneficial option you have. For example, taking 2 or 3 would exempt 7 lakh rupees of capital gain. But taking 4 as exempt would give only 5.8 lakh of exemption. So you would take ULIP 3 and 2 as exempt 1 and you would tax 4th one. Did you understand how do we proceed for ULIP taxation? Three steps are to be followed. First step is identify whether that ULIP is within 10% limit or not. Second thing, whether annual premium is up to 2.5 lakh rupees. If you have bought multiple ULIPs now, take the additions of all the ULIPs whose annual premium, sorry, after addition, if it is up to 2.5 lakh, now it would be exempt. If it is beyond 2.5 lakh, it would become taxable. You have to make permutations, combinations of different ULIPs in which the maximum exemption you can claim. Got it, sir? This is the only ULIP taxation that you must understand. This is the only ULIP taxation. People are frightened, people are unaware, people don't know about ULIP taxation, but this is the only essence of ULIP taxation. Sir, on 1st May 2021, I got some more money. I bought another ULIP whose sum assured is 35 lakh rupees. and annual premium is 2.5 lakh. Sorry, 3.5 lakh. Can I say this is within 10% limit? Of course, sir, this is within 10% limit. In addition to that, sir, is it beyond 2.5 lakh? Sir, it is beyond 2.5 lakh. It is absolutely taxable. It is absolutely taxable. Absolutely no strings attached. It is taxable. If annual premium is more than 2.5 lakh, now there is no way that it can protect you. There is no way that it can protect you. It will always be taxable. And the best part is, whenever you tax any ULIP now, it is taxed under the head capital gain, and it is taxed under 112A. Any ULIP is taxed under 112A. That means it is considered as listed securities only, and whatever the ULIP you sell now, tax rate of 112A shall apply to these ULIPs. How much taxation is applicable? See, whatever the money you received minus premium that you have paid till date, that you have to take. Premium, whatever you have paid, you have to take that. Sir, any ULIP, any money that you received on account of death of a person, for example, whether it was up more than 10%, whether it was less than 10%, whether it was more than 2.5 lakh, it is less than 2.5 lakh. If you receive any money on account of death of a person, if anybody receives money on account of death of a person, it is always exempt. Any ULIP maturity received on account of death of a person is always exempt, irrespective of the percentage of the premium, irrespective of the quantum of the premium. Got it, sir? Got it? Got it? This is the only ULIP taxation. This was the simplest ULIP taxation. Similar to that, we have LIP taxation as well. Similar to that, LIP taxation as well. What is there in LIP taxation? Understand. If you buy any life insurance policy in which sum assured is more than 10%, I mean, annual premium is more than 10% of sum assured. Annual premium is more than 10% of sum assured. In that case, any maturity would be taxable under IFOS. For life insurance corporation, LIP, it would be taxed under IFOS. But if annual premium is within 10% limit, then what do we do? In that case, now, if maturity is up to 1st April 2023, it will be exempt. Any premium paid, any amount of premium paid, even in crores, it would be exempt. Even in crores, it would be exempt. But sir, if it is issued on or after 1st April 2023, then provision says aggregate premium up to 5 lakh rupees would be only exempt. Aggregate premium up to 5 lakh rupees would be exempt. Whatever LIPs you are buying beyond 5 lakh limit, that would be taxable under the head IFOS. But if received on maturity, it would be exempt. Got it? So this is simple. LIC, LIP goes into the same direction of ULIP. Everything is same. Like, now try participating. Any ULIP, any LIP. If it is beyond 10% per premium, if premium is more than 10%, then what would happen? ULIP would be taxed under capital gain, LIP would be taxed under IFOS. If it is within 10% limit, then what would happen? You have to check ULIP. Cutoff date is 1st Feb 2021. Any ULIP issued before 1st April to 1st Feb 2021, any amount would be exempt. But after that, maximum 2.5 lakh can be exempt per year. Okay. For LIC, cutoff date is 1st April 2023. Any LIC bought before that would be exempt if it is within 10% limit. If it is issued after that, it would be taxable. It would be exempt only if it is up to 5 lakh rupees. Okay, sir. While considering the premium, do we have to consider GST amount or not? Even though GST has been removed, but still for some period it might be tested. For example, I pay a premium. I pay a premium of 4,90,000 rupees plus GST. Earlier it was 18%. Somewhere around added 60,000 rupees, 70,000 rupees, whatever it is. So my annual premium turns out to be 560. My taxable policy is 490, but my total premium amount is 560. Provision says this GST should not be considered while taking the 5 lakh limit. Even though GST has been removed, but some portion of your financial year might have GST as well. So for considering the 5 lakh limit, you don't have to check the GST amount. You don't have to consider the GST amount. Got it, sir? Got it, sir. Got it. Provision says if there is any LIC, if there is any insurance company in IFSC, and if such company issued some LICs, then it would be exempt irrespective of this 5 lakh limit. Okay. Yeah, that's it. That's it. That's all about ULIP taxation. That is only thing. Sir, can you answer one thing? Can you answer one thing? Sir, what happened was I bought a LIC life insurance. I bought a life insurance policy whose sum assured is 80 lakh rupees. Whose sum assured is 80 lakh rupees. Annual premium is 6 lakh. And I get 80C deduction of 1.5 lakh every year. I get 1.5 lakh every year. How taxation would be calculated? Remember, very, very beautiful point I'm telling you. See, after maturity, such annual premium is paid for 10 years. Okay, for 10 years. Huh? Whenever I will receive maturity now, maturity amount would be 80 lakh. Yes, maturity amount would be 80 lakh rupees. Minus premium paid, 6 lakh into 10, that is 60 lakh. Ideally, this should be case, but provision is very clear that if you have taken any expenditure while considering the income in any of the previous years, such expenditure would not be allowed. That means if you have taken ATC deduction of this annual premium, such premium will not be allowed as cost of acquisition. That means you have taken 1.5 lakh deduction. That means 4.5 lakh is the annual premium into 10. That means your total cost of acquisition would be 4.45 lakh rupees. This would be your annual premium paid, or this would be your total premium paid. Because on 1.5 lakh for 10 years, you have taken 80C now. So you would not get such premium paid as cost of acquisition. This would give you taxable LIP. Taxable LIP 35 lakh rupees, and this taxable LIP would be taxed under IFOS, income from other sources. Always remember this point. Always remember this point that if it is received at the time of death, it is exempt. It is always exempt. Any LIP received on account of death is always exempt. Got it? I hope I made things clear. This is the entire LIP taxation that is there in your syllabus. Any depth would be based on these pointers only. Nothing extra is there in your syllabus. If you see module now, you would see 35 pages, 25 pages for this LIP taxation. But you don't have anything extra. Just these 2 pages are enough. Acha. Any money received on account of human insurance policy will be taxed under PGBP. We will study this when we will study PGBP. Oh God. Oh God. Come on to slump sale. When you have a business unit to sell, whenever you have a business unit, will this example is in book? I mean that the example that I took right now is not in book, but this entire case has been mentioned, and uh this is mentioned here only. Okay, come on to slum sale. Sir, if you want to sell entire business, not individual assets. LIC example, this LIC example is not there. Huh? This LIC example, see, there can be any number of examples that I can keep in the book, but for I have to consider the last day needs as well. Huh? So the more the things that you can revise on last day only, that only I keep. Otherwise, these things are borne in mind that whenever we take deduction under any section, now you don't get deduction here. So this is something I believe that you should remember rather than giving example as well. If you want that, I can give example as well from next time. I can give example that as well. I have not given that example in book. Otherwise, book would become more bulky and that won't be coverable in last day. Got it. Got it. We got that point. Slum sale, section 50B. What this 50B says? Whenever you want to sell any business, and such business, you are not selling individual assets. What does that mean, sir? I have inventories, I have debtors, I have receivables, I have cash, I have bank, I have investments, I have licenses, I have multiple assets who are valued differently. I'm not considering individual assets. I am selling entire assets for a one consideration or a lump sum consideration. Such thing is called slump sale. Example must be clear. Whenever I sell any assets for single consideration, it is called slump sale. Multiple assets sold for a single consideration. In this case, capital gain would arise. If such unit is held for 3 years minimum, then it is considered as long-term capital gain. If it is held for less than 3 years, it shall be considered as short-term capital gain. In addition to that, tax rate under 112 would apply. Section 112 would apply. Okay? That is 12.5% would apply. Done, sir. Whatever I am saying next now, that is going to help a lot. Okay? Slump sale. How do we arrive? How do we get the calculation of capital gain? How do we calculate capital gain? How do we calculate? Sir, we need full value of consideration, we need transfer expenses, and we need cost of acquisition. Once we get these three things now, whatever the difference is, this is the capital gain. Yes, only we require three things: full value of consideration, transfer expenses, cost of acquisition. Transfer expenses is not our concern because it is always given in question. It is the percentage of sales, it is percentage of sales or any fixed amount, but it is given in question only. So transfer expenses is not our concern at all. It is not concern. We need to understand how do we compute full value of consideration. We need to compute how do we consider cost of acquisition. Sir, full value of consideration is taken as higher of 2, FMV1 or FMV2. And cost of acquisition is nothing but the net worth. Cost of acquisition is the net worth. Sir, what is FMV1, FMV2? Just understand this with an example. You will understand beautifully. For example, if I have a house and I give this house to Monica. Okay, I have a house and I gave this house to Monica. In return, she is giving me a gold chain. In return, she is giving me gold chain. So FMV1 would be the FMV of the assets gone. Whatever the FMV of the house is shall be considered. FMV1 implies FMV of the assets gone. And FMV2 shall imply whatever the assets have been received, FMV of that. If I'm giving up my house, take stamp duty value. If I'm giving up some shares, take the fair market value. If I'm getting something in return, take the FMV of that. So whenever you give any asset in a slump sale, now take FMV of those given assets as FMV1, and whatever thing that you are receiving in return, that shall be FMV2. Most obvious cases, ICI gives FMV2 as rupees only. You receive cash in return only. Most oftenly, you receive cash in return only. So FMV2 is mostly given in exam, but if they don't give, now you have to calculate. Okay. So how do we arrive FMV1? FMV1 simply means FMV, fair market value of assets given. It is normally calculated based on A plus B plus C plus D minus L. Very simple it is. If you have any building or if you have any immovable property, then take stamp duty value of such property. Stamp duty value of such property. If you have any shares, securities, take the FMV. Sir, how do we compute FMV? It is not given. If it is listed, take the average price. If it is unlisted, take the report of the chartered accountant valuation officer. Nothing is given. Just take FMV is given. If you are giving up your, for example, if you have painting in your unit and you are giving up the painting, or if you have jewelry, you are giving up that jewelry with the given unit. In that case, take the open market value based on merchant banker or chartered accountant's report. Take the open market value, and whatever the other assets are, other remaining assets, whatever the other remaining assets are, take book value. Take book value. Remember, if any revaluation done now. If any revaluation is done, do not ignore. Do not ignore. You don't have to ignore this. Huh? You don't have to ignore this. And take liabilities at book value. With the given fundamentals now, you will be able to solve every question. You will be able to solve every question. Huh? How do we arrive at FMV2? Assets received. If you receive cash, take that. If you receive shares in return, take FMV. If you receive jewelry in return, or for example, you are receiving painting in return, take open market value. If you receive building, land, immovable property, take SDV in return. This is how you have to consider FMV1 and FMV2. Sir, how do we arrive net worth? How do we arrive net worth? See, net worth is nothing but the cost of acquisition of the assets transferred. If you have any depreciable assets, depreciable, depreciable assets, take WDV. If you have any scientific assets, take nil. If you have any goodwill, take nil. If you have other assets like inventory, debtors, take at cost minus liabilities. This will give the net worth. If this net worth is negative, ignore. If it is negative, ignore that. Sir, during the entire process, now the most crucial thing where students do mistake is any revaluation is to be removed. While considering the net worth now, you are not allowed to revalue any asset. But while considering FMV revaluation is not to be ignored. Okay? With the given set now, you will be able to solve every question. You will be able to solve every question you will be able to solve. Got it, sir? Can you all recall it? Recall it to me. Can you all recall it to me? Can you all recall it to me? Sir, whenever you do any slump sale, FVOC, full value of consideration shall be higher of two. Full value of consideration shall be higher of two. FMV1 or FMV2. What is FMV1? Assets given up. If you are giving up building, take SDV. If you are giving up shares, take FMV. If you are giving any painting, jewelry, take open market value. Whatever other assets you are giving now, take the book value of that. If any revaluation done, do not ignore that revaluation. Even revalued figures are considered at book value. Minus liability will give us FMV1. FMV2 is nothing but assets received. If you received the cash, if you received the money, if you received the shares, if you received the jewelry, if you received anything, shares at FMV, jewelry at open market value, building or immovable property at book value, and any cash received shall be taken as it is. Net worth shall imply depreciable assets taken at WDV, scientific assets, goodwill at nil, whatever other assets you have at book value, minus liability. Any revaluation has to be removed. See, this is not something that I can make you understand more, but rather I want you to learn these things as well. Logics are apart, but here this is the thing that you should be aware of. You should be, this should be by heart. Okay. Now what do I do? It is 8:35. I am giving you 4 minutes time, or not just 4 minutes, 3 minutes time till 8:38. Okay. You have to write this and immediately send me on Telegram. I will be waiting. You have to write these entire pointers and send me on Telegram. Okay. You have to write this and send me a picture of this on Telegram. You don't have a choice. You have to write it and send on Telegram. I will be waiting till then. I will not proceed. Sir, but we don't have paper and pen. Arey Baba, so you take now. Acha, if somebody is not having any paper pen, now just write these things. Just type these things. FMB1, if you have any IP, SDB. If you have any shares, take FMB. If you have any jewelry, take open market value. But I want everybody should write these things once. These things at least should be written once by your hands. Okay. If you have paper pen in your hand, write the way I have written and send it to me on Telegram. If you don't want to write, you want to type the message on Telegram, but that should cover holistically the things that I have said. FMV1, like that, you have to tell. FMV2, you have to tell. And depreciable assets, you have to tell. You just have to write. I am giving you 3 minutes. I have given you 3 minutes just to respond. Write down, take a photo of it and send it to me on Telegram number. If not Telegram number, just type these messages, type these things and send it to me. I want you all to just write these things once. The more you write, the more you're able to understand. Monica says, done, sir. I have sent it to you. I have sent it to you. Oh wow, Monica, I received Monica's. I received Monica's answer. I received Monica's. You have 2 minutes, 2 more minutes. Write it down and send it to me. Sir, we never expected that in power batches you would wait for us to write. Are Baba, anything that will make you learn, I will do that. Okay? So this means we have to write everything. No, only few things. Surprisingly, which I ask, you have to write. So you will wait till the time we are done. Yes, at least till the time I have given. Sir, we have not seen any other faculties who wait for other students. So you have met me for the first time now. I'll wait. The time I have given, I'm giving you 1 more minute. Take 8:50, take 8:40. I'm giving 1 more minute just to write. After that, I'll proceed. Even if you don't send me, that's okay. Just write it down. I want you to write these things because these things people tend to forget. I also forgot when I used to write my MTP. I remember in my MTP when I attempted mock test, I forgot these slumps in. And as a student, if I can forget now, then I can understand anybody can forget. I was the weakest student. Anybody can forget. I got message from Dia. Received message from Dia. Well done. Very well done, Dia. Very well done. Okay, so time's up. Meanwhile, you can continue writing. I am switching on to the question for this. Understanding slum sale won't make any sense unless we solve question from this. Question bank PDF has been shared to you on Telegram channel. If you want to solve questions, do download it. Question number 43. page number 57. Question number 43, page number 57. Come on to question of SALC Limited. See, this is the question where you have to lead. Everything you have done now, you understood what the pointers are. Just put the data in that pointers and you will get the answer. You have the written answer, you have written format. Just put the data in the format and you will get the answer. SALC Limited has two units. One is engaged in manufacturing of textile and other is engaged in manufacturing of chemicals. One is into textiles and other one is in chemicals. SALC. One is in textile and the other one is in chemicals. As a restructuring drive, company sold its chemical unit as going concern. That means textile unit is there, but chemical unit has been sold off by the slum sale for 242 lakh rupees. That means, can I say FMB2 has been given to us? FMB2 has been directly given to us. Can I say that? Wait, idhar, see, my eyes. Look into my eyes. Can I say 242 lakh is the FMB2 given to us? Because we are receiving money in return. If we would have got shares, we would have taken that shares as well. But we have been given money, so we would take FMB2 as 242. Done, sir. On 1st October 2025, the balance sheet as on 1st October being the date on which chemical unit has been transferred is given to us. The balance sheet date has been given to us. Now, whenever you solve slum sale question, first thing that ideally should be done is ignore the data that is not relevant because it will only create confusion. Since the chemical unit is being transferred, whatever data for textile unit is given is not relevant. Just I am cutting that down so that I am not confused because otherwise I would do mistake in data picking. Okay, everything has been given. The chemical unit was established in 2020, which means we will have long-term capital gain. Since we are transferring in 2025 and this unit was established in 2020, that means we will have long-term capital gain. Land includes revaluation reserve. Okay, land was purchased at 50 lakh rupees, revalued at 70 lakh rupees, stamp duty value is 62 lakh rupees. Machinery and building have been shown as per WTV. Stamp duty value of the building is given. Licenses and franchises were acquired in 1st June 2024, shown in the balance sheet original purchase price. Okay. Equity shares were acquired on 2023, whose fair market value is 42 rupees. Okay. Okay. Compute the capital gain. For computing capital gain, we require three things now. Full value of consideration, for which FMV1, FMV2, higher of 2, or net worth. FMV2 has been given to us. Shall we consider FMV1? FMV1 is nothing but A plus B plus C plus D minus L. Do we have any immovable property? Do we have any immovable property? Just consider, do we have any immovable property? Yes, sir, we do have immovable property. For immovable property, we have to take the SDV. We have building as well. You have to take SDV of this as well. Whatever SDVs are there, you have to take. Land, SDV 62 lakh rupees. SDV of this land is 62 lakh rupees. And buildings SDV has been given to us as 72 lakh rupees. So D, immovable property will be 62 lakh plus 72 lakh. Do we have any shares? Do we have any shares? Yes, sir, we have shares invested in investments in equity shares. 1 lakh equity shares whose cost of acquisition is 35 rupees. See, for shares, we take the FMV. And FMV has been given to us here at rupees 42. So 1 lakh shares into 42 would mean 42 lakh would be the FMV. FMV would be 42 lakh. So 42 lakh we would take here. Do we have any painting? Do we have any jewelry? No, sir, we don't have any other thing. So we would ignore that. Whatever the other assets are, we would take at book value. So we have inventory of 60 lakh rupees. We have licenses of 23 lakh rupees. All in all, 83 lakh would be the other value assets. Liabilities are 47 lakh rupees. Doing everything would give us the FMV. Doing all these things would give us the FMV. 83 plus 42 plus 62 plus 72 minus 47. Sorry. I forgot this machinery as well. We have machinery as well. Okay, machinery as well. 83 plus 52 plus 42 plus 62 plus 72 minus 47. FMV1 would be 264. 264. Was it that difficult to derive? Was it really difficult to derive? If you are aware about the format, if you have written the format, you will be able to derive everything that is required. ठीक है? Now we need net worth. We need net worth. To derive net worth, now we require two things, three things. If there is any depreciable assets, take WDV of that. If it is non-depreciable asset, take book value of that. In any case, if any revaluation done, you have to remove the impact of revaluation. That's the only thing we require. Sir, we have land appearing at 70 lakh rupees. First of all, tell me one thing. Whether land is a depreciable asset, sir, land is not a depreciable asset. So it would be taken at book value. Sir, we would take it. But remember, land includes revaluation reserve. That means land was acquired for rupees 50. It was revalued to 70. So we would take the original figure. Revaluation has to be ignored. Second thing, building. Sir, building is a depreciable asset or building is a non-depreciable asset? Tell me one thing. Building is a depreciable asset or non-depreciable asset? Sir, building is a depreciable asset. And for that matter, we would take WDV of it. We would not take cost, we would take WDV. WDV would be given. It is given here. Machinery have been showed and written down value. That means whatever machinery we have now, this 70 lakh rupees, this is the WDV only. This is the WDV only. Machinery is a depreciable asset. Yes, therefore we would take it at WDV. Whatever the value of machinery is, it is already at WDV only, so we would take that. Sir, shares in a company, are these depreciable assets? The shares are not depreciable assets. If these are non depreciable assets, we would take at book value. Whatever the book value is, we would take that. Inventories, sir, are these depreciable assets? Sir, inventories are not depreciable assets, so we would take it at book value. Again, we would take that. Sir, licenses are depreciable assets or not? Sir, licenses are depreciable assets, so we would take it at WDV. But sir, is it appearing at WDV? There is an adjustment given to you that licenses were acquired on 1st June 2024 and these were showing at original cost. On licenses, we have not reduced the impact of depreciation. So this has to be taken at WDV now. These are appearing at cost. We have to remove the impact of depreciation now. So if we acquired licenses at 23 lakh rupees and for 1 year depreciation would be 25% on these licenses. So how much WDV it should be? 23 lakh minus 25%, that means 17 lakh 25,000. This would be the WDV of the license. Got it, sir? Got it. Very simple point it is. Yes, sir. Liabilities, you have to just reduce as it is. You have to reduce the liabilities. Tell me one thing. Whatever things that I have highlighted in blue, can you add them? And whatever the things that I have highlighted in red, can you reduce them? This will give you the net worth. Whatever the assets whose WDV is to be taken, we took WDV. If we were required to take book value, we took the book value. This is the only thing required to be done. Only thing. Nothing special. 50 lakh plus 70 lakh plus 52 lakh plus 35 lakh plus 60 lakh plus 17.25 minus 47. And this would give us the cost net worth as 237.25. 64 minus 237.25, this would give us the capital gain of 26.75 lakh, and on this 12.5% tax would apply. This is how you solve, and the way I have done now is the same way ICI has done, as it is no presentation issue at all. Full value of consideration minus net worth. How do we arrive full value of consideration? Take FMV1, FMV2. While considering FMV1, they have directly taken, they have not even considered ABCD. Ideally, they should have done, but they have not considered that. Net worth, very simple. Just take the WDV of depreciable assets, just take the book value of the remaining assets, and this would give you WDV. FMV2 is given to you. This gives you capital gain. Is it that difficult for which you were worried about? Is it that difficult? Just tell me, is it that difficult that you were, is it worth worrying? Is this question worth worrying? I personally never think that it is worth worrying. Sir, Slum sale means entire undertaking being sold. Full value of consideration minus transfer expenses minus cost of acquisition. This will be long term, short term, depending upon 3 years of period of holding. How do we derive net worth? If you have any depreciable assets, take WDV. If you have the 35AD self-generated assets, take nil. Other assets would be taken at book value. Reduce the liabilities and this would give you net worth. Ignore or adjust for any revaluation done. How do we derive full value of consideration? Sir, higher of two, FMV1 and FMV2. FMV1, if you have any in building, take SDV of that. If you have any shares, take FMV of that. If you have any jewelry or painting, take the open market value of that. Take book value of all the other assets minus liabilities and this would give you FMV1. FMV2 is the assets received. If you received cash, then take that. If you received shares, take FMV of that. Take building, take FMV of that. If you have received any jewelry, then take open market value of that. Entire valuation would be done on the slump sale date, which means the date on which transfer is done. Sir, whenever slump sale happens, you are required to get the net worth certified from chartered accountant before the tax audit due date. See, these are some tax saving tools. How can you save taxes on case of slump sale? Very useless pointers, but there are questions being asked from this. For example, this is Rahul, and I have two units. First one is textile unit, and the other one is chemical unit. We have textile unit and we have chemical unit as well. Now, how can we save taxes in this case? How can we save taxes? Provision says instead of selling this chemical unit, now what can you do? You can demerge this. If you do demerger, na, then it is an exempt transfer, so no tax would arise. Arey Baba, what a bullshit point it is. What a point it is. If you want to just remove the unit, what will happen if I demerge? Nothing will happen now. But since it is saying that it is a tax saving tool, we will accept that. Demerging an entity instead of doing slump sale, na, it would be an exempt transfer. It would save our taxes. In addition to that, it has also advised one thing. For example, if you want to sell this chemical unit to say Monica, if you want to sell this unit to Monica, instead of directly selling this, you can acquire 100% shares of Monica, 100% of shares of Monica, and it will make Monica as your subsidiary. 100% subsidiary, and if you transfer your assets to the subsidiary, it is an exempt transfer. So this, by this manner, again it will be exempt. So these are the two tax saving tools which in fact do not make sense, but this is what they have given. This is entire slump sale summarized to all of you. Clear? Clear to everybody? Clear, sir. Absolutely clear. Absolutely clear. अब तुम सा जहां में कोई नहीं है. Clear, sir. Capital asset distribution in case of liquidation. Capital asset distribution in case of liquidation. What does this mean? If I have shares in a company and company liquidates, it is a transfer happening in my hands. Ultimately, my right in a company is extinguished now. My right in a company is extinguished. For that matter, there will be transfer happening in my hand. Transfer happening in my hand. What will happen for the company? Provision says it is not taxable in the hands of the company. Whatever the asset that is being transferred now, it is not taxable in the hands of the company. It will be only taxed in my hands. It will only tax in my hands. And how taxation would take place, I'll illustrate you. I want one concept to be clear for all of you, to all of you. See, whenever liquidation takes place now, if a company has certain set of accumulated assets, and if liquidation takes place out of that accumulated reserves now, then whatever the distribution company does is considered as deemed dividend. We will discuss this under 222C, that if at the time of liquidation company distributes any assets to the shareholders, it is considered as deemed dividend. To the extent of accumulated profits, whatever the distribution company does, it is considered as deemed dividend only. It is considered as deemed dividend only. Now, how do we calculate capital gain in case of liquidation? I'll tell you. I'll illustrate one example. Give a strong focus on this. See, these special cases are important. Huh? Entire special cases will have certain newer pointers to discuss. So your focus should be undivided to these pointers. Okay. Sir, this is Rahul Private Limited. Share capital is 1 crore. All shares are held by Rahul. I am the only shareholder. Reserves and surplus are 9 crore rupees. This entity has a land of 10 crore. Land's FMV is 100 crore. All of a sudden, this company liquidated. This company liquidated. At the time of liquidation, land was given to Rahul. Land was given to Rahul. This land was entirely given to Rahul, the only shareholder. How would things take place? First of all, provision says na, it will be capital gain in hands of Rahul. It will be capital gain in the hands of the Rahul. This is the first thing. Plus, second thing, deemed dividend would be in the hands of Rahul. How much deemed dividend? Whatever the accumulated profits are, to the extent of any distribution shall be deemed dividend. Whatever the accumulated profits are, my accumulated profits are 9 crore rupees now. So whatever the distribution to the extent of 9 crore is would be deemed a dividend. So it would be deemed a dividend in my hands to the extent of 9 crore rupees. This is fixed. This is always going to happen, no strings attached. Whenever liquidation happens, the distribution to the extent of accumulated profits is deemed a dividend only. Distribution to the extent of accumulated profits is deemed a dividend only. Got it, sir? Yes, sir, we got that point. We got that point. How capital gain is computed to understand. Full value of consideration shall be taken as FMV of asset received. FMV of asset received. How much assets we received, sir? 100 crore of land we have received now. This asset is 100 crore land. We are receiving that. Cost of acquisition would be nothing but price paid. Price of shares. I acquired shares for 1 crore rupees, so 99 crore would be ideal capital gain. Ideal capital gain would be 99 crore. And this is what the answer would be. Did you all understand? Did you all understand this? Did you all understand this point? First of all, 9 crore would be deemed a dividend. And then whatever assets I am receiving, minus whatever the share prices, this would be capital gain in my hands. This would be taxable this would be taxable in case of liquidation. Clear to everybody? Everything clear? Everything clear? Sir, we did not understand one thing. How is it possible that Rahul is receiving just an asset of 100 crore rupees? Rahul is receiving just 100 crore of assets. 9 crore is taxed under deemed dividend head, and 99 crore is being taxed at capital gain. 108 crore is being taxed. 108 crore is being taxed. Are you understanding? I received asset of 100 crore only. My benefit is just 99 crore rupees, but I am being taxed 108 crore rupees. Simple reason being, this is being taxed twice. So provision says whatever the income that has been considered while calculating deemed dividend, this should be reduced while computing capital gain. So my capital gain would be 90 crore only. This is the ideal capital gain. This is the ideal capital gain, and this is what is mentioned here. This is what is mentioned here. Whenever capital gain is to be calculated in the hands of the shareholders, take sales consideration minus the cost of acquisition minus the amount that have been considered under 222C. Minus the amount that have been considered under 222C shall be taken. Done, sir? Done, sir. Done, sir. This is what the taxation and liquidation happens. Whenever company distributes any assets to the shareholders, there are two taxation taking place. First of all is the deemed dividend in the hands of the shareholders. Second thing, capital gain in the hands of the shareholders. Provision clearly states that deemed dividend has to be taxed, and whatever the amount that is taxed under deemed dividend will be reduced while calculating the capital gain. Got this point? I know these are technical pointers. I know we are going a bit fast, but the fact is, the best examples I can take you to illustrate the entire understanding is this one. I hope you are understanding. This is not difficult at all. It is difficult to digest because wherever you have studied earlier, I mean, might have taken more time, might have taken different examples. Of course, it would be difficult to take. But these are easier ones. These are not difficult at all. Okay. This is capital gain in case of liquidation. Okay, sir. Come on to section 50AA. Another next special case. The next special case. What this special case brings to us. Section 50AA is very special. Very special section. It has not been tested, and once it will be tested, you will realize the importance of this topic. 50AA says we will lay down three securities. We will mention three securities. These securities can be long-term capital assets, can be short-term capital assets. We don't care. These securities can be long-term capital assets. These can be short-term capital assets. We don't care. We certainly don't care. But whatever the capital gain arising on these securities would be always short term, always short term, always short term. Whatever the securities are, it can be long term capital assets, it can be short term capital assets, but capital gain arising on either of the securities will always be short term. This is what this 50AA speaks out. Now, what securities are being mentioned under this section? There are three securities mentioned, three securities. First of all is market linked debentures. Market linked debentures. Now, what are market linked debentures? Let me illustrate this to you. For example, I require money. I want money. I went to Dia. I said, Dia, can you give some money to me? Dia says, Arey sir, whatever I have is because of you. You can take whatever money you want. Dia is giving me any money. I said, Dia, why so generous? Dia, sir, I will charge interest from you. I was blank. I was shocked that Dia wants interest from me. I asked how much. Dia said, the market rate of interest. Market rate? I said, what market rate? Dia said, sir, I'm not able to ascertain how much interest to charge. I want some adventure in the interest. I want some adventure. See, this is the girl who wants adventure in interest. In interest, she's wanting adventure. I said, Dia, I will give you interest. I will give you interest 1.2 times of the gain that Nifty will make in 1 year. This will be adventurous for us, for her. If Nifty grew by 10%, I will pay her 12%. If Nifty grew by 20%, I will pay her 24%. If Nifty grew by 100%, I will have to pay 120%. If Nifty didn't grow, I will not have to pay. If Nifty will be negative, I will not have to pay. Are you getting? I have given adventure to the interest. Earlier, interest would have been fixed. Earlier, the interest would have been fixed. But right now, I have fixed this interest against an underlying asset. It can be market index. It can be any share. It can be anything. These securities are market-linked debentures, where interest is dependent upon an underlying asset. It is not dependent on anything else. It is dependent upon an underlying asset. It can be anything. It can be a share. It can be a stock. It can be a market. It can be a market index. Anything underlying. But interest is not fixed. Dia is not asking me 9%, 10%, 12% rate of interest. Dia is asking me an adventurous interest. Interest is dependent. Interest is variable based on some underlying asset. Got it, sir? This is market linked debenture. Second security that is mentioned under 50AA is specified mutual fund. Now, what are these specified mutual fund? See, if any mutual fund has been issued on or after 1st April 2023, if any of the mutual fund has been issued on or after 1st April 2023, and such mutual fund invests only 35% in domestic shares or in domestic shares company, in equity shares of a domestic company. What it says, if any of the mutual fund is issued on or after 1st April 2023 and it has invested only 35% in equity shares of a domestic company, then such mutual funds are called specified mutual fund. These are a kind of debt oriented mutual funds only. These are debt oriented. That means 65% is in debt. 65% is in debt. So these are debt oriented mutual funds, but two conditions attached. Remember, exposure to equity is up to 35%. Plus, these mutual funds are issued on or after 1st April 2023. Third thing, if you have any unlisted bonds, unlisted debentures, being redeemed, being matured, being transferred, being redeemed, being matured, or being transferred, it shall always be 50 AA, it shall always be short term capital gain. What did I say? 50 AA lays down the three securities. Whenever you transfer these securities, your capital gain will always be short term. Always be short term. Sir, what are these three securities? First of all is market linked debentures. Market linked debentures. Market linked debentures. Second thing is the specified mutual fund. Mutual fund in which 35% or lesser exposure is to equity. In addition to that, they have been issued on or after 1st April 2023. Third thing, unlisted bonds and debentures. I want you all to draw a skull here again. Based on my past experience, students tend to forget that 50 AA really exists. When you solve non-resident taxation, you tend to forget that 50 AA also exists. There are many questions of non-resident taxation where 50 AA can be applied, but ICI has never applied. Even students have never applied. What if ICI asks an exam and applies 50 AA? We are not sure. So we must be prepared of this section very beautifully. Important section, single star you can put on this topic. Whatever the capital gain you arrive, it will always be short-term capital gain. It will be always short-term capital gain. Got it, sir? Got it, sir? Got it. Securities held in Demat. Answer this question. Now, answer this question. Participate in this question. Now. You have to participate. Answer this question. This is the portfolio of Dia. This is the portfolio of Dia. Dia has acquired on 1st April 2025 Reliance. Bought one share of Reliance for 1500. One share of Reliance for 1500 she has bought. On 1st May 2025, again she got money. She bought one share of Reliance for 1600. On 1st, is there any limit, time limit to apply for unlisted bonds and debentures? There is no limit. To apply for unlisted bonds and debentures, limit anytime you can buy, na, Monica? Anytime you can buy, there is no limit. Maybe I didn't get your question. 1st June, Dia had an old share. Her grandfather had one share of Reliance which was held physically. She had physical share certificate. It was acquired for 100 rupees. Okay. She got it dematerialized. She got it dematerialized for 100. Okay. But this was originally acquired in 1990s. On 1st July 2025, she bought another one share for 1300. Now, on 1st August 2025, she sold one share for 2000 rupees. What will be the cost of acquisition for such share? Sir, will it be 1500 based on FIFO? Will it be 1300 last bought shares? Will it be 100 oldest stock, or will it be 4500 divided by 4? Will it be 1125 based on weighted average method? If you take the weighted average, it is 4500 divided by 2, 54, that is 1125. This is normally what happens. Weighted average is available on Demat. Whenever you see Demat account, na, weighted average price of the shares is given. Always weighted average price of the shares is given. What shall I take the cost of acquisition? See, whenever you have any physical assets, it is easier to consider because share price is given in the share certificate only. Whenever Whenever we have any physical shares now, physical shares, it is easy to determine the cost of acquisition because it is mentioned in share certificate. But if we have Demat shares, then how do we determine cost of acquisition? We cannot determine. So we have four methods. Either we can take the first share of the Demat, either we can take the oldest share, either we can take the last share, or we can take the average. Anything can be done. Which cost of acquisition should I be taking? Which cost of acquisition should I be taking? Unlisted bonds and debentures which is transferred or redeemed matured on or after. Then only this apply. Now, yes. See, Monica, for your attempt, previous year 25-26 is applicable. That means income from 1st April 2025 till 31st March is being applicable. Correct? Income will be taxed in this previous year only when transfer takes place in this year only. If transfer takes place in this year only, then only these provisions are going to apply. Then only they will be able to test 25-26. So transfer is bound to take place in this period only for your attempt. Therefore, whatever the old provisions are, you can ignore that. I know this provision came last year, but you can ignore that because that is not relevant right now. Right now, whatever questions you will receive will be for previous year 25-26 now. So whatever the maturity is going to take place is going to take place in this year only. Dia says this. Dia says 1125 weighted average, sir, because it is available in Demat. Dia says I will take, sir, weighted average because it is available on Demat. What other people say? What other people say? See, if you should participate. Even if you are wrong, you should participate. Sir, weighted average. Let me make things simple for you. Let me make things simple for you. We never take last share price. We never take the last share price. We never take that. Monica says FIFO. Monica says FIFO. What other people say? Satish says weighted average. Satish says weighted average. Satish says weighted average. Okay. Other people who just see the answers, who just look at the class but do not respond. Where will you go? By not responding. What will you earn? Do you get some benefit of by non-responding? Sir, let me make it more simpler for you. We do not take weighted average as well. We do not take weighted average as well. Bhaskar says weighted average. No, Bhaskar. We don't take weighted average. Sir, do we take the oldest share? No, we do not take oldest share. We take the FIFO method. This is the thumb rule that you have to follow. The share that has entered into Demat account will be first share to get out of the Demat. Sir, it might be possible that you have very old share existing, but that has been dematted later on. Provision says this will be out at third number only. The date on which you enter, the asset is entered, the share is entered into Demat now shall be considered. The date shall be considered for the purpose of FIFO, irrespective of the year of acquisition. You might have acquired the share way back in 1990s, but that is not relevant. The date on which it entered Demat shall be considered for the purpose of first in, first out method. Only FIFO is applied, and that is relevant in real life as well. FIFO method is only applicable for Demat securities. The reason is simple, because other methods are not that relevant. Second thing, sir, weighted average is not logical. Weighted average seems good, but it is not logical. Why? Because what if we get, for example, we got bonus shares? What if we got bonus shares in between? Then you would average out the price now. You would average out the price, but bonus shares have nil cost of acquisition. This would negate the provisions, earlier provisions. So weighted average is literally not allowed. Achha, what if I have some different account? For example, this is Zerodha. I have another account at Grow. Provision says account wise you have to apply FIFO in separate accounts. Okay, for different accounts, different first in first out method would apply. This is nothing but transfer in case of Demat securities. Whatever securities that are held in Demat format, any transfer taking in that place would be applicable here. Wow, sir. Last second important special case, that is advance money forfeiture. This is very simple. Provision says if you are intending to sell any house, if you are intending to sell any house, you receive some token money. If you are aware, I don't know what people call in South India, but we receive token money here. Okay, it is a gesture that somebody is intending to buy the house, so we receive some token money. What if later on the buyer does not come up? He is not willing to buy later on. Sir, I have right to forfeit that token money. I can forfeit that token money. I don't have to return that. Provision says that forfeiture of token money or advance money is taxable in your hands. How is it taxable? It depends when did you forfeit that money. If that money has been forfeited on or after 1st April 2014, that means the day Modi government came into the central government, the BJP came into central government. From that day, it is taxable under income from other sources. If advance money has been forfeited on or after 1st April 2014, it will be considered under income from other sources. But what if this has been forfeited before Modi government coming into picture? In that case, what would happen? It would be reduced from cost of acquisition. How? Let me tell you with one example. For example, this is Bhaskar. Bhaskar acquired asset in 2002 for 10 lakh. Received advance money on 1st April 2009, 50,000 from Shreya, who did not materialize the purchases, and later on Bhaskar forfeited this money. Later on Bhaskar sold it to Monica for 50 lakh rupees. See, for Bhaskar, full value of consideration will be 50 lakh rupees. Cost of acquisition will be 10 lakh rupees. But since he forfeited the advance money, Bhaskar has forfeited the advance money now, 50,000 would be reduced, 9.5 lakh would be considered as cost of acquisition, and 40.5 lakh would be ultimate. 40.5 lakh would be ultimate capital gain in his hands. What 40.5 lakh? Yes. Whatever the advance money that Bhaskar has forfeited now, in that case, that advance money forfeiture is reduced from cost of acquisition. It is always reduced from cost of acquisition if it has been forfeited before 1st April 2014. But here is a catch. What if, sir, Bhaskar forfeited the advance money from Shreya and gifted this house to his wife, gifted to his sister? What if Bhaskar forfeited the advance money and gifted this house to his sister? And sister sold the house for 50 lakh rupees. Now capital gain would take place in hands of sister. Capital gain will take place in the hands of sister. Yes. Full value of consideration for sister would be 50 lakh rupees. Yes. Cost of acquisition, since sister has got this house for free of cost, then cost of acquisition of the previous owner shall be taken. Cost of acquisition for the previous owner shall be taken. That means Bhaskar's cost of acquisition shall become cost of acquisition for his sister. Now, if sister is selling, whether advance money forfeiture is to be reduced or not, right answer is no. No advance money forfeiture is to be reduced. Absolute cost of acquisition shall be reduced, and capital gain would be 40 lakh rupees. That means if I am forfeiting the advance money and I am selling the house, then advance money forfeiture is reduced from cost. I am selling the house, then advance money forfeiture will be reduced from cost. But if I am forfeiting and somebody else is selling the house now, then in that case, he will not bear the reduction in cost. He will not bear. The person who is selling should only bear the cost. Otherwise, nobody else is bound to bear the cost. This is what advance money forfeiture looks like. Advance money forfeiture. forfeited. If Modi government coming into power, in that case it is taxable under IFOS. Before Modi government coming into power, reduced from cost. But if it is reduced by previous owner, if it is forfeited by previous owner and I am selling it, I will not reduce it. I will not reduce it. Okay. Almost we are done with all the special cases. We are only left with one special case, that is transfer of capital asset from partnership firm to partners. Let's discuss, let's brief it out. After later on we'll complete that. We'll take break, don't worry. Let me brief this case out to you. Transfer of capital asset from firm to partner. How things happen? Vice versa. People are worried about this concept, but honestly, there is nothing to worry about. Honestly, there is nothing to worry about. Sir, if partner has a piece of land and he gives the assets to the firm, partner is giving the assets to the firm, section 45(3) applies, which clearly states that capital gain will be applicable in the hands of the partner. How capital gain will be applicable? Full value of consideration shall be amount recorded by firm, minus cost of acquisition for the partner, and this will be capital gain in the hands of the partner. Done. Wow. Wow, sir, done. Thus, this was the only case. If partner gives any asset to the firm, partner gives any asset to the firm, sir, it is capital gain in the hands of the partner. Whatever the amount that has been recorded by the partnership firm in the books of accounts now, that will be the full value of consideration for the partner, and that is how capital gain is computed under 45(3). Done, sir. Wow, sir. But what if case happens differently? Firm is transferring assets to the partners. Sir, for that matter, you have to check whether the transfer is happening at the time of reconstitution or at the time of dissolution. You don't have to look at other cases. If firm is giving any assets to partners at the time of dissolution or at the time of reconstitution. So what is reconstitution? It can be admission of a partner, it can be retirement of a partner, it can be death of a partner, it can be change in PSR, profit sharing ratio. If any asset is being given to the partner at the time of dissolution, sir, section 9B is applicable. And if asset is being given at the time of reconstitution, section 45(4) plus 9B is applicable. Section 45(4) and 9B both are applicable. Both of them we will discuss after break. It is 9:23. Take break till 9:43 plus minus 2 minutes. Do come on time, because the more late you will do, the more chances that you will miss out this topic. I really don't want you to miss out this topic. Do it live with me. See you guys after the break. Hello, G. Welcome back. Okay, so we are back from break. Just before going to break, we started off with a topic that is transfer of capital asset from partnership firm to partner and partner to partnership firm, vice versa. Whenever any partner transfers any asset to the firm, 40 screen is locked. Okay. Whenever partners transfer any asset to partnership firm, in that case, whatever the amount is recorded by the firm is considered as full value of consideration and capital gain is calculated in the hands of partner. But sir, what if firm transfers the assets? Sir, we have two special cases in this case. If firm transfers assets in case of dissolution, then section 9b is applicable. If firm transfers asset in case of reconstitution, then 9b and 45(4) both are applicable. I would take a moment to take an example and make you understand the entire provision. A, B, and Rahul. There are three people in a partnership firm who has capital of 2 crore, 2 crore, 2 crore. A, B, R. 1st April 2025. Assets they have is land, cost was 2 crore, shares 2.5 crore, other assets 1.5 crore. If you are aware now, whenever reconstitution takes place, dissolution takes place, the partnership firm revalue their assets. So when they did revaluation, land was revalued at 4 crore rupees, shares were revalued at 3 crore rupees, and other assets were revalued. Sorry, shares were revalued at 3.5 crore, other assets were revalued at 2.5 crore. This is the revalued figures that they identified after reconstitution. On 1st April, Rahul resigned and he was given land of 2 crore. Simple fundamental it is, very simple pointer it is. If Rahul is retiring, his capital is due rupees 2 crore rupees. In return, we are giving him 2 crore worth of land. Any issues? Can you see any discrepancies here? Can you see any fault here? Can you see? I personally cannot see any fault, sir. I personally cannot see any fault. His capital due was 2 crore rupees, but he has been given land of 2 crore only. Land was appearing 2 crore rupees in our books of accounts. So no discrepancies. Ideally, this is not the case now. This is not the case. What government asks us to think, listen, government asks us to think, what if? What if you would have sold this land to an outsider? What if this land would have been sold to an outsider? Then firm would have incurred capital gain. Firm would have incurred capital gain. How much capital gain firm would have incurred if this land, were sold to an outsider? Then capital gain would have arisen in the hands of the firm. How much capital gain? See, if this would have been sold to an outsider, then 4 crore would have been the value because fair market value is 4 crore rupees. Cost of acquisition of this land would have been just 2 crore. That means 2 crore of capital gain would have been in the hands of the firm. Yes. How much tax? So 12.5% tax plus 12% surcharge plus 4% education says this would be tax in the hands of the firm. 2 crore into 12.5% into 1.12 into 1.04. All in all, 29,12,000 rupees is the payable tax. Don't you think it's logical enough? Don't you think it is logical enough? Government says this thing only. If you would have sold this land to an outsider, if this land would have been sold to an outsider, now, then firm would have easily got capital gain of 2 crore rupees. Firm would have easily got profit of 2 crore rupees, and 2.29 lakh rupees would have been taxes for the firm. Then pay this. Pay this. This is section 9B only. This is only section 9B. Section 9B simply says if you are giving asset to the partner at the time of dissolution or at the time of reconstitution, assume this would have been sold to an outsider. If you would have sold this asset to an outsider, you must have got some profit. You must have got some profit. You must have paid some taxes. Pay those taxes right now as well. Pay those taxes as well. Sir, what if firm would have given some stock in trade to partner? Then PGBP would have arisen. Section 9B also attracts PGBP. If any asset has been given to the partner, for example, if any asset is given to a partner which is stock in trade, provision says tax PGBP. If any asset is given to the partner, now assume that if it would have been sold to an outsider, then whatever capital gain, whatever the PGBP that would arise, same has to be borne by the firm under section 9B. 9B says the same thing. Assume it is sold to an outsider, whatever the capital gain, whatever taxes would have incurred would be taxable in the hands of the firm. Now, 45.4 goes beyond. 45.4 goes beyond. Listen to the tone what section says. Listen to the tone what section says. Important, really important. Section 45.4 says, if this land would have been sold to an outsider, if this land would have been sold to an outsider, the firm's capital account could have been this. A's capital was 2 crore, B's capital was 2 crore, Rahul's capital was 2 crore. If this land would have been sold to an outsider, then each partner would have got profit. Capital gain was 2 crore rupees divided by 3. That means 67 lakh rupees of profit, 67 lakh of profit, 67 lakh of profit. If this land would have been sold to an outsider, then firm was required to pay taxes. It is 29.12. I am assuming 30. I am assuming 30 for the simplification purpose. 30 lakh taxes were required to be paid. That means each partner was required to pay 10 lakh of taxes. So taxes are always debited to partner's capital account. That means if this land would have been sold to an outsider, then each partner's capital would have been 2.57 crore, 2.57 crore, 2.57 crore. If this land would have been sold to an outsider, each partner's capital would have been 2.57 crore. If this land would have been sold to an outsider, we would have had capital gain of 2 crore. We would have had taxes of 29 lakh rupees, and each partner's capital would have been 2.57 crore. Can you all agree to this point? That whatever I have done is logical. Whatever things I have done till now is logical. Can you all agree with me? Can you all agree with me that whatever things I have done till now are very fair and logical? Very fair and logical. Yes, sir. It is logical. We are giving asset to a partner. Instead of that, assume it is sold to an outsider. Whatever capital gain arises, we would pay that. Whatever profit arises, added to capital. Whatever taxes arise, we would adjust from capital. That means if this asset was sold to an outsider, each partner's capital would have been 2.57 crore. If this asset would have been sold to an outsider, capital would have been 2.57 crore. You all agree to this? The fact is, if this asset would have been sold to an outsider, capital would have been 2.57 crore. Then why did you give him assets of 4 crore rupees? Section 45.4 doubts the intention of the management that if this asset would have been sold to an outsider, his capital would have been just 2.57 crore. Then why did you give him asset of 4 crore rupees? Why did you give him assets of 4 crore rupees? That means there must be some benefit you have got from the partner. The benefit you have got from the partner. How much benefit you must have gone? 2.57 minus 4. That means 1.43 crore is the amount of benefit that partner has given you. This is the benefit that partner has given you. That is why you are giving him beyond his capital. And this is nothing but 45.4. This is capital gain under 45.4. Two things. 9B assumes that assets sold to an outsider, whatever capital gain arises, that would be taxed in the hands of the firm. 45.4 assumes that if partner was due 2.57 crore and you are paying him 4 crore. Why you are paying him 4? Because he must have given some benefit to you. that is taxed under 45(4). But sir, there is a basic fundamental issue in this concept. Fundamental issue. Partner is receiving asset only once. Partner is receiving asset only once. But once you are taxing as if it was sold to an outsider. Second time you are taxing whatever appreciation he has got against his capital. You are firm. The government is taxing this transaction twice. Government is taxing this transaction twice. So it is a fundamental issue now. It is a fundamental issue now that has to be resolved. For that matter, government says whatever the capital gain arises in case of 45(4), whatever capital gain arises in case of 45(4), first of all, firm pays taxes on this. Firm has to pay taxes on this. Firm has to pay taxes on this. But whatever the capital gain arises, this is allowed to set off. How much allowed to set off? Listen very carefully. Sir, whenever the reconstitution takes place now, there is revaluation of other assets as well. Other assets are also revalued. Like shares are revalued from 2.5 crore to 3.5 crore. Shares are revalued from 2.5 crore to 3.5 crore. Other assets are revalued from 1.5 crore to 2.5 crore. Provision says whenever other assets are being revalued, you just apportion this capital gain into the revaluation ratio. That means shares are revaluation by 1 crore, other assets are revalued by 1 crore. That means this 1.43 crore of capital gain will be reapportioned. 71.5 lakh will be apportioned to shares, and 71.5 lakh rupees would be apportioned to other assets. Sir, we didn't understand this point. What I'm saying is whatever the capital gain arises in 45(4), you have to reapportion this capital gain to the revalued assets in the ratio of revaluation. Again, try speaking this out of your mouth. Whatever capital gain arises in 45(4) has to be reapportioned in the assets, on the assets that have been revalued in the ratio of revaluation. In this ratio, you have to reapportion. Sir, what will happen of this reapportion capital gain? For example, these are shares. These are shares. Okay. Shares were acquired for 2.5, whose FMV has been 3.5. Revaluation done is 1 crore rupees. And apportion capital gain is 71.5 lakh. This is the apportion capital gain. In this case, for example, if I sell these shares, for example, later on at 4 crore rupees, cost of acquisition would again be 2.5. 1.5 would be capital gain. Provision says since 71.5 is the apportioned capital gain, now you are not required to pay capital gain on this amount. 71.5 lakh rupees is to be removed. Your taxable capital gain would be 78.5 lakh rupees. This is the entire 45(4) and 9B. Entire 45(4) and 9B. Got it? Try understanding this point very carefully. If a partnership firm distributes assets to a partner at the time of dissolution and reconstitution, assume it would have been sold to an outsider. Now, whatever capital gain, whatever PGBP would arise, that would be taxed under 9B. Whatever the capital account is, consider that. And in addition to that, whatever money that has been given to the partner, now that would be taxed under 45(4). In this case, we are taxing same transaction twice. So to avoid double taxation, what do? Whatever the capital gain that has been incurred at the time of 45(4) is allowed to set off. How it is allowed to set off? Whatever the capital gain arises now, it is apportioned. It is apportioned into the revalued assets in the ratio of revaluation gain, in the ratio of revaluation. Okay? Capital gain under 45(4) is apportioned into revalued assets in the revaluation ratio. Okay? Just to make it simple, I am making one line. Capital gain in case of 45(4) is apportioned on revalued assets in revaluation ratio. Clear to everybody? Clear to everybody? Are Baba, clear to everybody or not? Sir, clear, but we didn't get the comfort. Okay. Okay, I see. 45.3 implies if partner transfers any asset to firm, then whatever the amount recorded in the firm is the full value of consideration. Okay. 9b, in case a capital asset or stock is distributed by the firm to the partner, firm distributes any asset to the partner. In that case, such distribution shall be such distribution shall be taxable under that capital gain and PGBP, whatever the case it is. If firm is giving any asset to the partner, if it is a capital asset, then capital gain would arise. If it is a stock, then PGBP would arise. Assume that it would have been sold to an outsider. Whatever cap gain or PGBP would arise would be taxed in the hands of the firm. If money is being distributed, it is not considered. 45.5 is confusing. 45.5? Monica, 45.5? I didn't get 45.5. 45.4 are you talking about? Okay. Okay. Again, I'll take that example. Again, I'll take another example. I know that is confusing, but I will take that example. You have to process things. You will get that. Same thing I'm asking here. Another example we have. Just understand this with example. You can just understand this with example. Carefully see this example. I'm repeating this. See, in power batches, the limitation is only this. I cannot repeat multiple times. But this is topic I understand everybody lacks. So in this case, have a strong focus. If you have any doubt at any point of time, just ask on the spot. Mr. Prem is a partner in firm X and Company. So there is a company, X and Company, which is in Mumbai. X and Company has 4 partners, including Mr. Prem. So Mr. Prem is one of the 4 partners. Profit and losses shares equally. That means Mr. Prem is having 25% profit share. Prem resigned from X and Company on 1st April 2025. Prem resigned on 1st April 2025. Beautiful. On the said date, capital balance of each of the partners stood at 32 lakh rupees. Oh. That means on the resignation date, capital balance is 32 lakh rupees. Okay. In order to settle the dues of Mr. Prem, the firm revalues its land for the first time since purchases. The valuer also valued self-generated goodwill at 70 lakh rupees. The firm has following capital assets. Firm has land at Pune, which was acquired in 2012-13 for 15 lakh rupees. It is revalued at 50 lakh rupees. Can you all tell the amount of revaluation? Can you all tell the amount of revaluation? Sir, revaluation is 35 lakh rupees. Land at Nagpur, 2015 is the acquisition year. 25.4 lakh is the acquisition price, and it is revalued at 45 lakh rupees. That means 19.6 lakh is the revaluation amount. This is the amount by which this land has revalued. Land at Mumbai, acquired in 2013 for rupees 88 lakh rupees and is now revalued at 250. That means, can I say 162 lakh rupees is the revaluation figure on this Mumbai land? This is the amount of revaluation. Goodwill, which was 0 earlier, it is self-generated, is now valued at 70. That means revaluation on goodwill is 70 lakh rupees. Yes. Yes. Sir, these things up to this point, everything clear. In addition to that, X and Company gave Nagpur land. That means this 45 lakh rupees land, has been given, plus 15 lakh has been given to Prem to settle his accounts. See, that means firm is giving Nagpur wali land, which is worth 45 lakh plus 15 lakh cash. Oh wow. Oh wow. First of all, ask this question to yourself. If this land was not given to Prem and sold to an outsider, how much capital gain would the firm had? How much capital gain would the firm had? Try answering that. Sir, if 45, if this land would have been sold to an outsider, if this land has been sold to an outsider, then 45 lakh would have been full value of consideration. Cost of acquisition would be 25.4 lakh. That means capital gain in the hands of firm would have been 19.6 lakh. Yes, this would have been the capital gain in the hands of the firm. This cap gain is taxed at 12.5% plus 4% education cess. 19,60,000 into 12.5% into 1.04. That means 254800. This has to be paid by the firm. This has to be paid by the firm under 9B. Let's check. Oh my God, sir, absolutely matching. No difference at all. Wow, amazing. Why will it not match? Just consider, why will it not match? Again, Monica, listen. Second step, what government asks, assume this land would have been sold to an outsider, then what would have been partner's capital account? Before transferring any asset, partner's capital account was 32 lakh. Prem's account was 32 lakh rupees. If this land would have been sold to an outsider, then 19.6 lakh would have been the capital gain, which was distributed between four partners. That means 4 lakh 90,000, 4.9 lakh would have been capital account of each partner. Yes. Taxes amount 254800 divided by 4. That means 63,700 would have been the taxes. That means just before dissolution, if this asset would have been sold to an outsider, how much capital account would have been? The 32 lakh plus 4 lakh 90,000 minus 63,700. All in all turns out to be 36 lakh 26,300. If this asset would have been sold to an outsider, this would have been the capital account of the partners. Yes, Monica said yes. This capital would have been 36 lakh. And in return, you are giving him 60 lakh worth of assets. 45 lakh of land you are giving him, 15 lakh of cash you are giving him. That means nearly you are giving him 60 lakh worth of assets. 60 lakh worth of assets you are giving to him. Why you are giving a 60 lakh? You must have got some benefit. Huh? You must have got benefit from the partner. That means how much benefit you must have got from partner? 23 lakh 73,700. This is the benefit you must have got from the partner, and this is nothing but taxable under 45(4). Monica, clear up to this point. Clear up to this point. Clear up to this point, sir. We have got some benefit from the partner. That is why this is being taxed in our hands under 45(4). But the issue is, partner has got asset only once now. He has got asset only once, but once we are taxing under 9B. Second time we are taxing the same transaction under 45(4). So what provision says, whatever the capital gain arises in 45(4) now, this has to be shared between the different assets. This has to be reapportioned between the different assets. What are the different assets? Sir, we have land at Pune, we have land at Mumbai, we have self-generated goodwill. We have three types of different assets. This capital gain is to be shared between the three assets in the ratio of the revaluation. The revaluation ratio is what? 35 is to 162 is to 70. In this revaluation ratio, this profit has to be shared. See, sir, is it real? Yes, it is real. For example, our capital gain was 23,73,700 as you all calculated. 35 divided by 267, that means 3,11,000 is to be shared by Pune land. Similarly, 14,40,000, 6,22,000 is to be shared by Mumbai and self-generated goodwill. Sir, what we will do of this capital gain, whenever you will sell this Pune land, whatever the capital gain will arise, you will get a deduction of this capital gain already apportioned. That means whatever the apportionment is being done to the assets now, you will sell these assets later on. Whenever you will sell these assets, you will get a deduction of this apportionment. You will get a deduction of this apportionment. This is about 45(4) and 9B. If you want to listen to this point, again, you can rewind this video as many times. This is the finest explanation I can give in the given time. Okay? Whatever examples I take in regular batch, and I took those examples. Both the examples I take in regular batch. Na diya. Taxes to be paid. Taxes to be paid right now, right away. Taxes to be paid right now. But you get a benefit later on. See, if you are being taxed today, you will be taxed twice. You have to pay taxes twice. But later on, you get the benefit of reduced capital gain later on. Later on, whatever the capital gain will arise, then that will be lower. So you will get benefit there. Right now, you have to pay taxes twice. But later on, whenever you will sell the remaining assets, you will have to pay lower capital gain tax on those assets. This is the benefit that you got. Sir, 45(4), 45(3), and 45(9)B. All these apply mutatis mutandis to AOP BOI. The way I told you, firm gives any asset to partner, 9B 45(4) are applicable. Similarly, if a AOP gives any asset to its member, same 45(4) and 9B would apply. Same 45(4) and 9B would apply. Monica, is it clear to you? Is it clear to you? Any doubt? Sir, I don't like you taking my name personally in class. I personally don't like. Arey Baba, you will thank me later on. You will thank me after the batch is over. No, you will thank me. Clear, sir. Clear. Absolutely clear. Where do we stand right now? Where do we stand right now? I said now always stick to this chart. Otherwise, you will not understand where do we stand right now. Always stick to the chart. You need 65 marks in May 26. We understood the definitions, we understood the computation portion, we understood the full value of consideration, we understood cost of acquisition, and then we came on to special cases. In morning, we understood ULIP taxation. Slum sale in depth, we understood with example, with question also we did one. Then we did 50AA, we did liquidation, we did advance money forfeiture, we did Demat securities, and we did 45(4). That means at this point of time, you are able to calculate every kind of capital gain that is there in your syllabus. Every kind of capital gain that exists, you will be able to calculate. Now, point comes as to how do we save the capital gain. Now, capital gain has been calculated. Now you have to save it. Once you will save it, then you have to tax it. Got it? So this flow has to be maintained. Basics, then computation, then advanced computation, then exemption, then tax rate. This flow has to be maintained so that you are aware of what you are doing. Come on to exemptions. Sir, exemptions. What are exemptions? So there are 5 exemptions right now, 5 or 7 exemptions, 9 exemptions broadly we have. First of all is section 54, what it says. If you are an individual or HUF who has transferred residential house property and you have got a long-term capital gain, individual HUF transferring residential house property and getting long-term capital gain, provision says we will exempt this long-term capital gain provided you buy a residential house property in India. You buy one residential house property in India. Sir, can you buy 2 residential house property? Right answer is you can buy 2 residential house properties as well, but only if your capital gain is up to 1 crore, up to 2 crore rupees, and this option is only to be exercised once. Ideally, you can buy only 1 residential house property, but once in a lifetime, you can buy 2 residential house properties if your capital gain is up to 2 crore rupees. So till when you have to buy, provision says you have to check, you have to identify the date of transfer. You have to identify the date of transfer. From date of transfer, you can buy within 2 years. You can buy within 2 years. You can get constructed within 3 years. Or if before the transfer date you have acquired this property within 1 year, now all these 3 cases would be eligible for exemption. Okay? You have to buy the house, you have to get the house constructed, anything you can get done. But remember, either in 2 years you have to buy, or 3 years you have to get constructed, or a year back you can buy as well. How much exemption would be given to you? You will be given exemption amounting to capital gain, amounting to 10 crore rupees, or amounting to cost of new asset, whichever is lower. You might have capital gain of 12 crore rupees. You might buy house of 11 crore rupees. Your exemption would be maximum 10 crore rupees. Maximum exemption allowed under this section is 10 crore rupees only. Sir, whenever you buy a new residential house property, there is a lock-in period involved. You must hold that residential house property for minimum of 3 years. For minimum of 3 years, you have to hold that residential house property. Sir, if you sell it, what if you sell it? Sir, whatever the exemption claimed earlier was will be reduced from cost. Whatever the exemption claimed earlier now will be reduced from cost. Sir, what does that mean? Let me take an example for you. For example, Rahul had a house acquired for 10 crore, 10 lakh, acquired for 20 lakh rupees, sold for 50 lakh rupees. Capital gain, capital gain would be full value of consideration 50 lakh minus cost of acquisition would be 20 lakh. That means capital gain would be 30 lakh. To claim exemption on this capital gain, I bought a new house for 40 lakh. I bought a new house. How much exemption will I be getting? Exemption I will be getting capital gain amount, cost of new asset, or 10 crore, whichever is lower. I will get exemption of rupees 30 lakh rupees, yes. That means I will be exempted. Provided provision says the new house that you are buying now, should be held for 3 years. This new house should be held for 3 years. If you sell this house within 3 years, what will happen? Provision says, for example, I sold this house in 1 year for 55 lakh. So how capital gain would be arise? Full value of consideration would be 55 lakh. Cost of acquisition of this new house should be ideally 40, but provision says if you sell it within lock-in period, whatever the exemption claimed earlier was shall be reduced. That means here in case exemption claimed earlier was 30 lakh rupees now, so 30 lakh would be reduced from cost and only 10 lakh would be allowed. That means now 45 lakh would be taxed in your hands. Got it, sir? Got it. If you sell this house before the lock-in period, now whatever exemption claim earlier will be reduced from your cost of acquisition when you will sell this house. Okay, sir. Okay. Sometimes what happens is now, if I want a bigger house, okay, a bigger flat, bigger apartment I want, but bigger apartment is not available, so I buy two adjacent apartments. A small apartment, another small apartment. I break the wall in between, get the necessary modifications done, and make it one house. Will it be eligible for exemption? Will I be considering buying two houses or single house only? Sir, if you buy two different houses and get necessary modifications done and make it one, provision says it is considered as one house only. Provision says it is one house only. There has been multiple case laws based on this point. One of them is Anand Baspa case law at Karnataka High Court. If you remember the name, well and good. If you don't remember, that's okay. But remember, if you buy two adjacent houses and get necessary modifications done, it will be considered as one house only. Even if you buy from different buyers, even if different sellers, even if you buy based on different sale deeds, different price would be okay, different agreements would be okay, different dates would be okay. But if necessary modifications are done to make it one, it shall be considered as one only. Sir, whenever I am getting a house constructed, whether cost of land, cost of building would be considered. See, for example, I want to get a house constructed. For that matter, I want to buy a land now. So whether land cost would be allowed to us? Of course, sir, land cost would be allowed to us. Sir, if I am willing to claim exemption by buying a house, can I buy a house in the name of my mother? Can I buy a house? Everything I am today is because of my mother. Can I buy a house in name of my mother? Can I buy a house in name of my mother? Just tell me. Shouldn't I be this much obliged to her? Everything that I am is because of her. Can I buy a house in my name of my mother? Sir, I can buy a house, but this assessing officer will give exemption or not? He has to give the exemption. He has to give exemption. You can buy a house in anybody's name and you will still be eligible for exemption. Only condition here is consideration should be paid by you. If you pay the consideration, you get the exemption. Done, sir. Perfect, sir. This is all about for 54, section 54, which talks about sold residential house property and bought residential house property. Sold residential house property and bought residential house property. This is section 54. Section 54F. Section 54B, what it says. Again, you are an individual or HUF. Again, you are an individual and HUF. Here, what you have is, here you have an urban agriculture land. Urban agriculture land. You sell it. Provided that you have used it for 2 years, minimum 2 years. If you have urban agriculture land and you have used this urban agriculture land for minimum of 2 years, in that case, what would happen? Provision says whether it is short-term capital gain and whether it is long-term capital gain, we will exempt that. We will exempt that. if you have any urban agriculture land being sold, it has been used by you for 2 years, whatever capital gain you arise, either it is short term or long term, it will always be exempt, provided by selling urban agriculture land, you buy urban agriculture land or you buy a rural agriculture land. Urban agriculture land or rural agriculture land, whatever you buy, that's okay. Till when you have to buy? Sir, from date of transfer, within 2 years you have to buy. Within 2 years you have to buy. How much capital gain would be allowed, sir? Capital gain calculated or cost of new asset, whichever is lower, would be given to as exemption. Remember, whenever you buy a property, whenever you buy an urban agriculture land or rural agriculture land, you should hold it for 3 years. If you do not hold, if you sell within the lock-in period now, sir, whatever the exemption claimed earlier is, it shall be withdrawn. Exemption claim earlier will be withdrawn and it will be reduced from cost. The way we understood now, the same way it will be reduced. If you sell this property within 3 years now, whatever the exemption claimed earlier was will be reduced from cost of acquisition. Done, sir. Done, sir. Done, sir. Done, sir. If you don't have any doubt, I have two doubts for you. If you don't have any doubt, I have two doubts for you. Will you answer that? Will you answer that? Sir, at one point provision says that it has been used for at least 2 years. Section 54B is only applicable when you sell urban agriculture land which has been used by you for 2 years. On the contrary, it also says that short-term capital gain and long-term capital gain, whatever it is, we will exempt that. How come is it possible that you have used it for 2 years and still have short-term capital gain? Is it possible? Is it even possible that you use this property for 2 years and you still get short-term capital gain? Is it possible? Don't you think there is a flaw in lawmaking? There is some flaw in lawmaking. Can you see? Can you think? Can you think that there is a flaw in lawmaking? Hmm? There appears to be a flaw in lawmaking. Right answer is right answer is there is no flaw in lawmaking. As such, there is no law. There is no flaw in lawmaking. Issue involved here is now that it is saying it should be used. It should be used. What if I am using that as a tenant? What if I have been using this property as a tenant from 10 years? And last month only I got the ownership of this property and I am selling it. Can I have short-term capital gain? Right answer is yes. We can have short-term capital gain. Am I using it for 2 years? Yes, I am using it for 2 years. That means, is it possible that I can use it for more than 2 years and still have short-term capital gain? Yes, it is possible because this 2 years is not for the ownership. This 2 years is for the usage. This 2 years is for the usage purpose. Okay? You can use it as a tenant as well. Second doubt that has come to my mind. Just listen to this point. Huh? For example, provision says you can have capital gain on urban agriculture land. If you sell any urban agriculture land, you are eligible for exemption. Okay. I sold urban agriculture land and bought rural agriculture land. I bought a rural agriculture land. Provision also states that you must have a 3-year lock-in. 3-year lock-in. You cannot sell this land within 3 years. What if I am a DEET person? You understand DEET person? You understand DEET person? I don't know how to speak that English in English, but what if I am that bad person that I have sold this rural agriculture land within 1 year only? What will happen? Let me take an example. For example, we have urban agriculture land acquired for say 20 lakh rupees, sold for 50 lakh rupees. Rural agriculture land acquired for 40 lakh rupees and sold in 6 months for 60 lakh rupees. That means in case of urban agriculture land, full value of consideration would be 50 lakh. Cost of acquisition would be 20 lakh. Capital gain would be 30 lakh. Exemption would be 30 lakh. No capital gain would arise. In case of rural agriculture land, we sold 60 lakh rupees. Cost of acquisition was 40 lakh rupees. But sir, since we sold this rural agriculture land within lock-in period, provision says cost of acquisition shall be reduced. Cost of acquisition shall be reduced by exemption claimed earlier. That means our capital gain would be 50 lakh rupees. That means our capital gain would be 50 lakh rupees. Provision says no. Provision says absolutely no. Absolutely no. Absolutely no. Provision is very clear at this point. Very, very, very clear at this point that even if you sell rural agriculture land within the lock-in period, no capital gain will arise because rural agriculture land is not a capital asset and no capital gain arises in case of not a capital in case of non-capital assets. So no capital gain is going to arise if you sell rural agriculture land within lock-in period. This is the kind of tax planning that people do in the market as well. But yeah, that is not our subject matter right now. Section 54D. What this section speaks out, see, this is a very particular section. What it says, see, if you have land or building that have been used, beautiful Jayashri, beautiful Jayashri. If you have any rural agriculture, sorry, if you have any land or building which has been used for industrial undertaking means you have a factory, and you have land or building in that factory, and this industrial undertaking land or building has been compulsorily acquired. What did I say? Any land or building that has been used for industrial undertaking has been compulsorily acquired. Then any long term, that has been used for 2 years as well. Whatever long term or short term capital gain arises, that would be exempt if you buy industrial undertaking land or building. Land or building for industrial undertaking, that would be exempt. So if industrial undertaking, land or building has been compulsorily acquired, whatever the capital gain arises would be exempt if we buy new land or building for industrial undertaking. Within 3 years, you have to buy whatever the cap gain or cost of new asset is, whichever is lower will be exempted to you. If you do not hold this asset for 3 years, provision says whatever the exemption claimed earlier will be reduced from cost of asset. These are not the sections that you must be worried about. Next section is important, section 54 EC. For the first time, this section is available to everybody. I mean, first of all, most important thing that this section is available to every SSC. Section 54 EC is available to everybody, and this has to be borne in mind. First section that is available to companies as well. Not other sections are available. These are not available to companies. 54D is available, but this is very specific case now. So 54 EC is very important from companies' point of view as well. Provision says any person who transfers land, building, or both being a long-term capital asset. If you transfer land, building, or both, which is a long-term capital asset, provision says whatever the capital gain you have, long-term capital gain, or in some cases you might have short-term capital gain as well, that will be allowed to you. That will be exempted to you if you buy bonds of these 6 companies. Take a breath. Asset has to be long-term, being land or building. Capital gain can be anything. Long-term capital gain or short-term capital gain, it can be anything. Whatever capital gain you arise, it will be exempt in your hands, provided you buy 6 of the bonds, any of the 6 of the bonds. What are the 6 bonds? You can buy bonds from National Highway Authority of India. You can buy bonds from Rural Electrification Corporation Limited. You can buy bonds from Power Finance Corporation Limited. You can buy bonds from Indian Railway Finance Corporation Limited. You can buy bonds from HUDCO, that is Housing Urban Development Corporation, or you can buy bonds from IREDA, Indian Renewable Energy Development Authority. It is something like that. You can buy bonds of any 6 companies. Whatever bonds you buy now, maximum exemption that would be allowed to you in 6 months. So 50 lakh rupees is the maximum exemption that would be allowed to you. You have to buy bonds within 6 months from the date of transfer. 6 months from date of transfer. Done, sir. How much capital gain would be exempted, sir? Capital gain amount, cost of new asset, or 50 lakh, whichever is lower, would be exempted in your hands. Remember, very careful point. If you have a bond, you must hold that bond for 5 years. You can neither sell this bond, you cannot convert this bond into money. Sir, what is meant by conversion into money? You can you can loan it out, you can mortgage it to somebody and take loan in return. Provision says no, that is not allowed. If you convert that bond into money now, it is not allowed. Exemption will be withdrawn. Exemption will be absolutely withdrawn and it will be taxable in the year of violation. Simple, sir, simple, sir, simple, sir. 2 pointers I need to point out. Just try answering these 2 pointers. Sir, try answering these 2 pointers. Sir, if I transferred asset on 1st April 2025 and I wanted to buy bond on 28th September, I made the payment. But bonds are allotted to me on 15th October. Whether I will be allowed exemption or not. Whether I will be allowed exemption or not. Sir, I made payment within 6 months, but allotment took later on. I made payment within the specified limit, but allotment took later on. Sir, will I be allowed exemption or not? Logical as well as reasonable question. I made payment of time, but allotment was done later on. Sir, whether I will be allowed exemption or not, right answer is I will be allowed. I will be allowed. Why I will be allowed? Basic reason, provision states that payment is in my hands now. Payment is in my hands. Only thing that is in my hands is payment. Beautiful, beautiful, Monica, beautiful, Satish. Payment is in my hands. I can only do the payment. Nothing else is in my hands. If payment is in my hands, done. Simple. I made the payment within 6 months. I will get the benefit. Now listen to next point very carefully. Okay. This was the case of Miss Jayashri. Miss Jayashri. Miss Jayashri has a business. For the business, she acquired a building in 2008 for rupees 25 lakh. She acquired a building. Right now, building is valued at 60 lakh rupees, but WTV in her books is just 5 lakh rupees. Today, she sold building for 70 lakh and bought bonds of IREDA 40 lakh, NHAI 20 lakh. Calculate taxable cap gain. I am giving you 2 minutes to solve this question. 2 minutes I am giving to all of you to solve this question. 2 minutes time to all of you to solve this question. I'm waiting for you all. Just respond. Monica says 3 lakh rupees. Monica says 3 lakh. Okay. Okay, 30 lakh. Okay, sorry. I see. Shall I solve or should I wait? You are solving. This is not the question in which you should take you should ideally be taking time. This is not the question. Sir, full value of consideration in this case would be how much price we are selling it at, sir? We are selling it at Satish says 15 lakh. Okay. Sir, how much full value of consideration would be? Sir, full value of consideration would be 70 lakh rupees. Cost of acquisition. In case of depreciable assets, sir, cost of acquisition is considered as WDV. In the morning only we understood. In case of depreciable assets, Jayashri said the same answer. Jayashri said the same answer. Sir, cost of acquisition would be 5 lakh. Because in case of depreciable asset, we only consider cost of acquisition is WDV. Written down value is the cost of acquisition. That means short-term capital gain will be 65 lakh rupees. Are you getting short-term capital gain? This is short-term capital gain. Will I be getting exemption? Will I be getting exemption? On depreciable assets, I receive short-term capital gain. On depreciable assets, we get short-term capital gain. Will I be getting exemption? My question is very clear. Will I be getting exemption? Sir, it is a short-term capital gain. Short-term, short-term. Oh, short-term. Will I be getting exemption? Right answer is yes, we will get the exemption. Yes, we will get the exemption. Because, because it is not relevant that gain, whatever we can have. Asset has to be long-term capital asset. Asset has to be long-term capital asset, and since we held this asset since 2008 till today, it is a long-term capital asset, irrespective of the capital gain we have. Since capital asset is long-term capital asset, now we would get exemption. We would get exemption. How much exemption we would get, sir? 40 lakh rupees of IREDA, 60 lakh rupees of NHI. Maximum exemption that we would get is 50 lakh rupees. Therefore, our taxable capital gain, short-term capital gain is 15 lakh rupees. Now tell me, is it clear to all of you? And this is not me saying, this is said by Supreme Court in case of Hindustan Unilever case. Sorry, not Hindustan Unilever, but VS Dempo case. In case of depreciable assets, it is explicitly mentioned in case of depreciable assets being long-term capital asset. It might happen that you might have depreciable assets which are long-term, held for more than 2 years. But sir, capital gain is short-term capital gain. It has happened, it is bound to happen that capital gain is short-term capital gain. Provision says it will still be eligible for 54 EC exemption. It was said by Supreme Court in case of VS Dempo. Got it? Got it, Ji, got it, got it, Ji, got it. This was the only case law I wanted to tell. Therefore, I made this theory. I made this example. Section 54F was what the Section 54F speaks out. Carefully listen. This section talks about any asset other than residential house property. If you sell any asset which is other than residential house property, you might sell gold, you might sell land, you might sell commercial house properties, you might sell shares, you might sell mutual funds, you might sell anything, anything, anything. Yes. Satish, I forgot to tell. It is always short-term capital gain. This we will discuss in PGBP. This we will discuss in PGBP. I hope whenever you transfer any business asset, it is always short-term capital gain. We will discuss this in PGBP. Okay, we will discuss this in PGBP. Section 54F says if you transfer any asset other than residential house property, you can transfer any commercial house property, you can transfer any land, you can transfer gold, you can transfer debt-oriented mutual funds, equity-oriented mutual funds, shares, bonds, business trusts, anything you sell other than residential house property, your capital gain would arise and exemption would be given under 54F. Provision says any asset you can sell other than residential house property, you just have to buy the residential house property. The asset that you are selling now, that should be long-term capital asset. Long-term capital asset. Sir, capital gain can be long-term, but in some cases it can be short-term as well. For example, you are selling assets which belong to 50AA. In this case, capital asset can be long-term capital asset. Like capital gain will be short-term capital gain. In this case, whether 54F would be allowed? Yes, 54F would be allowed in 50AA cases. So asset has to be long-term. Capital gain can be long-term and short-term. And this was the point I was talking about. I say now we understand things from examiner's point of view. And this is the area where examiner is going to ask in upcoming attempts. Somebody is selling unlisted bonds and want to claim exemption. Can he claim so? Yes, he can claim so. Because section 54F talks about long-term capital asset, not long-term capital gain. Therefore, exemption would be allowed. Exemption would be allowed under 54F even on unlisted bonds and debentures. This is where examiner is going to be in upcoming attempts. Sir, what you have to buy to claim exemption? You have to buy one residential house property in India. If you buy one residential house property in India, that would be allowed. Sir, till when you have to buy? Provision says from the date of transfer within 2 years you can buy. Within 3 years you can get constructed, or before the date of transfer, if within 1 year you have already bought, you can claim exemption on that as well. How much capital gain would be exempted? Provision says whatever the capital gain is now, that will not be exempted entirely. It will be exempted multiplied by cost of new asset divided by net consideration. In this ratio, exemption would be done, or 10 crore rupees, whichever is lower. Or 10 crore rupees, whichever is lower, would be exempted. Similarly, again, you buy a new house now, you should hold that house for minimum 3 years. The lock-in period is 3 years. You must hold that house for minimum 3 years. If you sell it, whatever the exemption claimed earlier was will be taxed in your hands. Sir, what if me and my wife combinedly buys a house, but entire compensation, entire payment is being made by me? In that case, I will be entitled for entire deduction, entire exemption. The person paying the consideration matters the most. Here it is not relevant who is being registered, who is the registered owner. It is not relevant. Relevance is who pays the compensation consideration. Sometimes what happens, we buy a house. Okay. We get the house constructed, and within 3 years, almost entire construction is done. But small petty work like floor fittings, like tiles, these marbles, like pumps, like electricity, these are some small pending works are there. Can I say house is not constructed? Right answer is no. House is deemed to be constructed. If petty work is pending, it is deemed constructed only. Another important point: if you have a house, if you have a house and you want to claim 54F, now you can claim once. What do I mean? The date on which you are claiming 54F, now the date on which you are claiming 54F, you can have only one residential house property other than property that you are buying. That means if I have a house and I sell my shares and buy a new house property, can I claim 54F? Right answer is yes. But once I acquired this property, I will have two properties. Now can I claim 54F? Right answer is no. The date on which you are claiming and the property you are buying, apart from that new property, you can have only one property, one residential house property. If you have more than one residential house property, you will not be allowed to claim 54F. Got it? 54F is very clear. It is for the benefit of the people so that people can buy more houses. They can have their own houses. For that matter, provision clearly states that if you have a house property, you can buy one property under 54F. But it will have two. Then if you have two house property, you cannot claim 54F again. Okay? On the date of claiming the exemption, you can sell your house 2 or 3 months back and then rebuy it again. That is allowed, of course. But the fact is, the date on which you claim the exemption, you can only have one residential house property other than the one you are buying. Now, next 2 minutes, if you are able to understand things well, then well and good. If you are not able to understand, you can skip this point because I personally don't think that examiner is going to ask this point. Next 2 minutes, you can relax. Okay? If you are able to understand, well and good. If you are not able to understand, you can skip this point out. This was the case, for example, Mr. Goli. This was the name, Mr. Goli. Goli is the name of the person. He sold the house for 60 lakh rupees. Cost of acquisition was 35 lakh rupees. Capital gain was 25 lakh rupees. Not house, but he sold land. He sold land. Okay. Assessing officer, while considering the case, disregarded the sales price. He said, Bhaiya, SDV is 80 lakh rupees now. SDV is 80 lakh rupees. So your full value of concession would be 80 lakh rupees. Cost of new asset would be, cost of acquisition would be 35 lakh rupees and your capital gain would be 45 lakh rupees. Assessee claimed full value of consideration as 60 lakh rupees and capital gain of 25 lakh rupees. Assessing officer disregarded this and considered 45 lakh rupees as the taxable capital gain. Assessing officer did this. The assessing officer did this. Very politely, assessing officer did this. Okay, sir. Now, this assessee wanted to claim exemption. He wants to claim exemption on 45 lakh rupees. What he did, sir, he bought a house. Out of 80 lakh rupees, he bought a house of rupees 70 lakh rupees. 80 lakh is the net consideration. Yes, 80 lakh is the net consideration. He bought a house of 70 lakh rupees. How much exemption he should be allowed? 45 divided by 80 into 70. 39.375 is the exemption he should be allowed. That means 5.625 is the capital gain he should be taxed. Yes. Fair and logical. Fair and logical. Now listen what assessing officer are arguing. Assessing officer is saying, no, Goli, no, this 70 lakh is wrong. You cannot take this 70 lakh rupees as the cost of new house. Why? Because when you sold this house, you received 60 lakh rupees only now. You received 60 lakh rupees only. So how can you put extra money of your own pocket? No, we will not allow exemption from your own pocket money. When you sold the house, you got only 60 lakh rupees. 10 lakh you are putting from your own pockets. So we will not allow exemption on this own pocket money. Only money you received on the sale of asset was 60 lakh. So we will give you exemption on 60 lakh only. We will not give you exemption on 70 lakh. What the foolish thing that assessing officer is saying? Are you getting? First of all, he himself increased the sales consideration to SDV. He himself increased the sales consideration from 60 to 80. Now, if assessee is putting his own money to claim the exemption because he has only got 60 now. If he has sold the house for 60, he has got 60 only. So to claim a higher exemption, he must require money from his own pocket. So he is bringing 10 lakh rupees from his own pocket. But assessing officer is denying that I will not give you exemption because you are taking money from your own pocket. Your sales consideration was in fact 60 now, so I will give you exemption on 60 only. This is what assessing officer is saying. What a foolish thing. This is what is written here. Where stamp duty value has been adopted as full value of consideration. Where stamp duty value is considered as full value of consideration. Then reinvestment for acquiring the house property, which is an excess of net consideration, can be considered for the purpose of calculating 54F. That means if 60 lakh was the consideration received For buying new house property, you require extra money and you put it out of your own pockets. This extra 10 lakh would also give you exemption, because assessing officer had denied exemption on this 10 lakh, saying that you put this money out of your own pocket, we will not give. This was denied by assessing officer. But High Court, I mean, it was Karnataka High Court in case of Goli Mahadevappa case law, said this, that exemption would be entitled even if you put money out of your own pockets. But maximum exemption that can be allowed to you is to the net consideration. To the maximum of net consideration you will be given. This is a case law, important case law, but I don't think it is much relevant. Understanding purpose के लिए it is important, but exam purpose के लिए I really doubt how they are going to ask. ठीक है? This was all about 54 to 54F. Should I do a fast recall? Just a very quick recall. Your eyes looking at my eyes. ठीक है? Your eyes looking at my eyes. Section 54. Any individual HUF selling a residential house property has to buy a residential house property in India. He can buy two residential house property. He can buy two residential house property if capital gain is up to 2 crore rupees, but once in a lifetime. In addition to that, he has to buy within 2 years. He had to get constructed within 3 years. He can buy within last 1 year as well. How much capital gain would be exempted? The capital gain amount or cost of new asset, whichever is lower. Sir, whatever property he is buying, he should hold it for 3 years. Otherwise, whatever the capital gain arises, it should be reduced from cost. If you buy two adjacent house and do modifications to make it one, it shall be still allowed for exemption. Section 54B, if you are an individual HUF who transfers urban agricultural land which has been used by you for at least 2 years, any short-term, long-term capital gain would be allowed to you. When it will be allowed, you have to buy urban agricultural land or rural agricultural land within 2 years. Whatever the capital gain was or cost of new asset, whichever is lower, will be exempted to you. You have to hold that urban agricultural land for at least 3 years. If you don't hold it, whatever exemption claimed earlier will be reduced from cost of asset. If you buy a rural agricultural land and so sell it within lock-in period, now you will not be taxed at all. 54D, if you have land or building of industrial undertaking and it has been compulsorily acquired, then whatever the long-term, short-term capital gain is, it will be exempt in your hands, provided you buy land or building for industrial undertaking within 3 years from the date of transfer. If you sell it within 3 years after acquisition, whatever the capital gain earlier will be reduced from cost of acquisition. Section 54EC, you are any SSC. You are transferring any long-term capital asset, being land or building. Capital gain can be anything, short-term, long-term. You just have to buy the bonds of NHAI, RECL, PFCL, IRFCL, HUDCO and IREDA. Government will exempt. How much exemption government is going to give, sir? You will be getting exemption of 50 lakh rupees or cost of new asset or capital gain, whichever is lower. In this case, you have to buy bonds within 6 months from the date of transfer. In addition to that, sir, you have to hold these bonds for at least 5 years. If you sell these bonds within 5 years or convert them into money, it shall become taxable. Sir, payment is to be made on time. Allotment is not important. At last, even if you sell long-term capital asset and still have short-term capital gain, it is possible in case of depreciable assets. Sir, in this case, still you will be allowed exemption under 54F, 54EC. Last, 54F. If you are individual HUF selling any asset which is a long-term capital asset other than residential house property, you will be given exemption, provided you buy one residential house property in India within 2 years or acquire 3 years within 3 years from the date of transfer. How much capital gain would be exempted? Long-term capital gain into net consideration divided by into cost of new asset divided by net consideration. This will be exemption amount. You have to hold this property for 3 years, otherwise it will be taxable in your hands. If you buy within 3 years and some floor, if you get the house constructed within 3 years and some floor fittings is pending, it is allowed. The day on which you are claiming the exemption, on that day you can have only one residential house property other than the one you are buying. And at last, sometimes SDV is taken as full value of consideration. Now, in that case, you have to chip in some extra money to fulfill the exemption criteria. Whatever extra money you put, that is also eligible for exemption. This is about 54 to 54F, all the exemptions. 2 more exemptions, 54G and GA. GGA. Section 54, G and G is just to study simultaneously. G says any person, GA says any person. G says transfers land, building, plant and machinery of industrial unit of an urban area. That means you have industrial unit of an urban area and you are transferring land or building, plant and machinery from that unit. Okay. GA also says the same thing. Land or building, plant and machinery of industrial unit of urban area, you are transferring that. G says you can have long-term capital gain, short-term capital gain. G also says long-term capital gain, short-term capital gain. Wow. Bilkul same. What you have to acquire? Sir, you have to acquire, construct a new plant and machinery in rural areas, shifting from urban. Oh, here from urban you are shifting to rural and you have to buy new plant and machinery or land or building. But here you have to purchase plant and machinery in SEZ. Here you are transferring from urban to SEZ. In one case, you are transferring from urban to rural. In other case, you are transferring from urban to SEZ. From transferring urban to rural, you have to acquire new plant and machinery or land or building. From transferring from urban to SEZ, you can have second-hand plant and machinery as well. So till when you have to buy, either within 3 years from the date of transfer or 1 year prior to the date of transfer, you can buy in both the cases. Whatever the capital gain is or amount invested in cost of new asset, whichever is lower would be exempted. You have to hold these assets for minimum of 3 years, then only exemption would be continued. Two important pointers in this entire 54G and GA. Two important pointers are there. Sir, 54G talks about urban to rural. Here, plant and machinery has to be new for claiming exemption. In 54GA, your urban transfer has to be made to SEZ. And here in this case, plant and machinery can be second hand. In both the cases, sir, exemption on furniture is not allowed. You will be asked question in this. Furniture exemption is not allowed in this case. Okay. So there is a small concept of CGAS. What does that mean? See, ultimately, if I am asked to buy an asset within 2 years, in every case you will see, in every case, we are given 2 years time limit, 3 years time limit, 2 years to buy the property, 3 years to get house constructed. We are given a longer period of time, very long period of time we are given. Okay, very long period we are given. Sir, how government would know that we have bought or not? How government would know that we have bought or not? See, ultimately, we are asked to buy an asset. 2 years time limit, somewhere 3 years time limit has been given to us. But what if we do not buy? How would government know that we have bought or not? For that matter, provision says if you want to claim exemption, you have to deposit some money. You have to deposit the capital gain amount to the CGAS. Capital gain account scheme you have to open and you have to deposit the capital gain amount to the CGAS. Till when you have to deposit? Before ROI due date, you have to deposit that. And whenever you deposit it now, it shall be deemed to have been utilized. Now, whenever you want to buy, you just take out the money from the CGS and you can use this money to buy any property. Done, sir. Very simple point it is. Section 1037, very silly section. Very silly. Or I should say shitty section. I don't know why does this section exist, but it exists. This is about Amravati. If you know Amravati in South India, I mean, you all are from South India only. See, what happens is, few years back, when Chandrababu Naidu became CM for the first time. Okay, CM, I mean, not for the first time, but became CM in 2014-15, I guess. At that time of Andhra Pradesh separated from Telangana. And capital of both the states was Hyderabad and it was shifted to Telangana. Right now, Andhra Pradesh does not have any capital. At that point of time, Chandrababu Naidu decided that we would have Amravati as our capital. Amravati as our capital. For that matter, what they did now, they wanted some place. So what they did, they acquired land from farmers. Of course, they said that they would make a world class city, that would beat Singapore, They would make this city. They would make this big city. Chandrababu Naidu said. For that matter, what they required, they took fertile lands from farmers, and farmers also gave this land beautifully because they wanted nation development, nation first. Everybody contributed their property. Okay. In return, what they were promised, in return, what they were given, sir, they were given a promise. That today we are taking land from you. Once we will develop the city here, we will have big houses, big multi-story building, and there we will give you flats. There we will give you flats. Your value would appreciate. Wow, what a great thing. Just think of from farmer's point of view. Okay, I have given my land to the government. In return, I have got nothing but a piece of promise that I will be given land when city is constructed. What do I do of this promise? What do I do of this promise? Sir, of course, I am going to sell this promise to somebody else. What do I do of this promise? Just to ease that things out, provision says whenever a, a farmer who has transferred his piece of land to government in case of Andhra Pradesh, whatever transfer happened is an exempt transfer. If farmer has transferred any property or compulsory acquisition took place, it is an exempt transfer in the hands of the farmer. No capital gain would arise. In return, he has been allotted a promise. A promise is a normal word, but in legal term we call it LPOCs, land pooling ownership certificate. Land pooling ownership certificate. Farmers were allotted LPOCs. They were not given any money. They were given LPOCs. If farmer had no money, they can sell these LPOCs to anybody outsider. Provision says any sale of LPOC would be exempt under 1037A. But sir, what if they continue to hold this piece of LPOCs till the time city is constructed? Provision says they can continue. That's okay. They will be given piece of land. That is also okay. Once they have been allotted piece of land, they can sell this land within 2 years from the end of the year of allotment. For example, in previous year 25-26, they have been allotted. So they can sell it up to 31st March 2028. They can sell it. At any point of time, if they sell now, whatever capital gain arises, that is also exempt. But after this, if they sell now, after 31st March 2028, if they sell, then whatever the SDV on 31st March 2028 is, shall be taken as cost of acquisition for people of Amravati. What did I say? If compulsory acquisition took place, that is exempt transfer. If I sell the LPOCs, that is also exempt transfer. If I receive flats, if I receive houses, I can sell that house within 2 years from the end of the year in which I got them. That is also exempt transfer. But if I did not send the second year end, whatever the SDV would be, that SDV shall be my cost of acquisition for my further sale. There is another exemption section 1037, which talks about, sir, if I have urban agriculture land, if I am an individual and HUF, if I am an individual and HUF and I have urban agriculture land, urban agriculture land, that is compulsorily acquired. Okay. Okay. Has been used by me for 2 years and compensation has been paid by RBI. Provision says it is exempt. Individual HF, urban agriculture land, used for 2 years, compulsorily acquired, compensation paid by RBI, it is always exempt. Section 1037. Sometimes what happens is RBI does not pay the compensation. Provision says it shall still be allowed. Exemption shall still be allowed. Got it? Got it. There is a small provision. Okay. Understand this. Huh? For example, I have an urban agriculture land. I used it for 2 years. It was compulsorily acquired and compensation was decided 20 lakh rupees. I was not satisfied with the compensation. Is it necessary that I'll always be satisfied? No, sir. It is possible that I'm not satisfied with compensation. I won't hire a compensation. What are the options available to me? I can go to court. I can cry, Judge Sahab. It is injustice to me, my lords. It is injustice to me. I have been a victim of injustice in front of the eyes of Lord. I have been suffering injustice. I can cry this way. This is the way. Overacting. Yes, overacting. Second thing I can do is I can go to collector. When I do overacting, I feel I'm doing good. But when I see my image, I feel like how you are able to tolerate me. How you are able to tolerate this overacting. See, there are two ways. Okay, there are two ways. Either I can go to court and request court to increase the compensation. Second thing, I can go to collector and request the collector, Sahab, sir, you have done the work. Something extra can you give? I can go to collector and ask. One of the SSC went to collector. He did not go to court, he went to collector. One of the SSC did not go to court, he went to collector. You know what assessing officer did? Assessing officer said, you are okay with the compensation. You are not arguing to the court. That means it is not a compulsory acquisition. You are voluntarily selling it. Oh my God. Oh my God. The fact that somebody beat it on your face and you did not argue, that means you are okay with beating up on the face. Everybody can beat you. This is what assessing officer said. If you are not arguing in the court, it is not a compulsory acquisition, it is a voluntary sale. But Baba, what a foolish thing that assessing officer is saying. What a foolish thing assessing officer is saying. It is illogical. If we do not go to court, rather we go to collector for negotiating higher compensation, that never changes the nature of the sale. It is always a compulsory acquisition. It will never become voluntary sale. Got it, sir? Got it, got it, got it. These were the exemptions. Come on to the chart here. Come on to charts. Where do we stand right now? Where do we stand right now, G? Section 54 to 54 GA, Section 1037 and 1037A. We are done with all the exemptions. Till this point of time, we understood basics. We understood the computation purpose. How do we arrive full value of concession? How do we arrive cost of acquisition? How do we arrive the special cases? We also understood the exemption portion, how exemptions take place. And now we have to tax them. We have to tax them. Just focus on taxation purpose. Taxation is beautiful and yet simple. Let's have a glass of water and then continue. Meanwhile, how you all are doing? How you all are doing? Everybody who is live, just drop high. Just drop high. Sometimes I take these breaks. Some 1 or 2 minutes break I take. Just for my mind to relax and your mind also to relax. How you all are doing? Hi, sir. See, Monica is good. Monica is doing whatever is required. Energetic, along with that doing questions as well. In addition to that, participating in class. Jai Shri. Bujji Kanna. What is your name? Bujji Kanna is your name for the first time or second time I'm seeing your message. We have Satish. Okay, hi sir. Hi sir. See now, whenever you sit for long, now this small 1 or 2 minute conversation helps a lot. I have seen this. It helps a lot. No, perfect, sir. We all are doing good. We all are doing good. Come on to tax rates. Basically, under capital gain, tax rates are less. We get a benefit of lower tax rates at capital gain. Ideally, normally a person is taxed at 30%, but capital gain tax rates are lower. If you sell any asset which is falling under 112A, you have tax rate of 12.5% over 1.25 lakh. Whatever capital gain you arrive now, 1.25 lakh has to be removed and you get a benefit of 12.5%. Whatever capital gain fall under 111A is taxed at 20%. Whatever capital gain that fall under 112 is taxed at 12.5%. Whatever the other STCGs, it is taxed at slab. Yesterday I found one issue. Okay, one issue. I had given a question as practice. We will discuss that towards the class end. But one issue I found throughout. What issue I found? Understand. For example, I have listed equity shares. And capital gain under section 112A was 640 lakh rupees. Okay. What most oftenly I saw in the DPQs now, people wrote this 40 minus 1.25 lakh. That is 38.75 lakh. This will become GTI, this will become NTI. 38.75 lakh. tax would become 38.75 lakh into 12.5%, and whatever the figure is. This is what students have done. This is what students have done. This is a clear blunder. This is a clear blunder. Why am I saying this is a blunder? Because this 1.25 lakh is a benefit available for tax calculation purpose. This 1.25 lakh benefit is available for tax calculation purpose. It is not available for computation purpose. Sir, for total income purpose, this 1.25 lakh is not to be considered. This is only considered for tax calculation only. Tax calculation only. Remember, I'm serious on this point. Huh? If you have done it correctly, well and good, appreciable, commendable. But if you are not aware, just remember this point carefully. This 1.25 lakh is not to be reduced while computing the total income. This is only reduced while computing the taxes. Got it? Sir, we got it. We were already aware of this thing. Huh. Most of the things that you tell, we are already aware. Then you are a good student. You are a good student. Section 112A, what it says? Provision says if you sell any equity shares on which you have paid securities transaction tax at the time of purchases and at the time of sales as well. If you sell any equity oriented mutual fund on which you have paid securities transaction tax at the time of transfer, or if you have sold any business trust on which you have paid STT, on all the three cases, sir, you will be taxed at the rate of 12.5% over 1.25 lakh of gain. Whatever the gain you arrive now, 1.25 lakh would be ignored, and over and above whatever the gain is, that will be taxed at the rate of 12.5%. That would be taxed at the rate of 12.5%. Simple point. Sir, even though whatever I'm going to tell for next 5 minutes is least relevant in the entire syllabus, it is least relevant. But if you want to listen, listen carefully. Sir, if it is least relevant, why would we listen? Because you are a good student, you will listen. See, in basic parlance, now we say that securities have to be listed. Securities have to be listed to claim the benefit of 112A. But in fact, this condition is not there. Listed condition is not there. Condition is that STT has to be paid. STT has to be paid. On STT is where applicable. STT is applicable when they are listed. So we normally say that shares have to be listed, mutual fund have to be listed, businesses have to be listed to make it 112A. But this is not the direct answer. They have to be, STT has to be paid on those securities, and STT is required when they are listed. Sir, but there are certain conditions. There are two cases. First of all, a case where even if you don't pay STT, you will still be getting 112A benefit. There are three cases. Even if you don't pay STT, you would still get the benefit. And there are three cases. Even if you pay the STT, you won't get benefit. Two scenarios. Okay, less important. I'm saying now you can close your eyes and just listen to me. You can just sleep out. You can just have a water. This is not important topic. Three cases where even if you pay STT, you will not get benefit. Three cases. Even if you don't pay STT, you will get the benefit. What are those three cases? Sir, I am buying securities before 1st October 2004. Sir, at that point of time, STT was not there. So how will I pay STT? Government says in case STT was not even applicable back then, if you have bought securities back then you will be given benefit even if you have not paid STT. Second thing. Sir, you buy securities on which STT is not even applicable. For example, you got ESOPs. When you buy ESOPs, STT is not applicable because ESOPs are off-market transactions. STT is not applicable. If you buy shares on account of slump sale, STT is not applicable. On these cases also, you get a benefit. Third thing, if you buy and sell shares on recognized stock exchange and IFSC, STT is not applicable, but you still get the benefit. So normally, STT has to be paid to get the benefit of 112A. But in three cases, even if you don't pay, you get benefit. Where STT is not applicable, where STT is not there in force. Third thing, where securities have been sold on recognized stock exchange and IFSC. Three instances where even if you pay the STT, you don't get benefit. Even if you pay the STT, you don't get the benefit. What are those three cases? First of all, you buy some non-frequently traded shares. A share on which there is no trading being done. For example, there is a share called Porval Auto Component Limited. It is being traded at 45 paisa. No trading whatsoever is being done in these shares. You are buying those shares now. Provision says even if you pay STT, government is not going to give you 112A benefit. It is a not frequently traded share. But sir, if FIIs do, if QIBs do, if because of SEBI order we are buying, we will be given benefit. But otherwise, if we buy in a non-frequently traded shares, we will not get the benefit. Second case, sir, we buy shares otherwise than recognized stock exchange. For example, we buy shares from New York Stock Exchange. We are also required to pay security transaction tax there. Will we get 112A? Sir, we will not get. We buy shares on Chennai Stock Exchange. We are required to pay STT there. Will we get benefit? No, we will not get. That means if we buy shares otherwise than recognized stock exchange now, even if we pay STT, we will not get benefit. Provided if we buy on account of SEBI order, High Court order, NCLT orders, or we buy shares on ESOPs, if non-resident buy shares on FDI guidelines, if we buy because of SEBI regulations, if we buy from government, if we buy on account of slum sale, if FII buys or any investment fund buys, they are allowed. They can buy from Chennai Stock Exchange. They are allowed to buy from the Kolkata Stock Exchange. They can buy from any of these. Okay? Third thing, if you buy shares after delisting and before relisting, if a company is delisted from stock exchange and that company is again relisted, at this point of time, even if you pay STT in some case, now you will not be allowed 112A benefit. Okay. So three cases where even if you don't pay STT, you get benefit. What are those three cases? You bought shares which on which STT was not even there in force. Second case, you bought shares on which STT is not applicable, like ESOPs, like slum sale assets you got, like IPOs. Third case, you buy shares on recognized stock exchanges, IFSC. In these three cases, STT is not applicable, so even if you don't pay, it is okay. But three cases where you have to pay STT, even if you pay, you will not get benefit. First of all, you bought not frequently traded shares. You bought shares otherwise than recognized stock exchange, and you bought shares after delisting before relisting. This was about STT. Okay, this is law less relevant. You need to just remember that shares, equity-oriented mutual funds, and units of businesses. If STT has been paid, you will be getting benefit. Got it, sir? Now come back to the main point. Now you can come back. If you are sleeping now, wake up. If you are sleeping now you can wake up. Okay? You can wake up now. Sir, if you consider, what benefit do you actually get? Do you actually get a benefit under 112? If you see, since the time tax rate has been increased to 12.5%, do you actually get a benefit under 112? Honestly, you don't get a special benefit. Only 1.25 lakh benefit, 10,000 benefit you get. What's there? What's special in that? Are you getting me? Earlier, it used to happen that 112A was taxed at 10%. Later on, it and 112 was taxed at 20%. So there was a big arbitrage in tax between the different types of long-term capital gains. But right now, we don't have that tax arbitrage. All the long-term capital gains are taxed at 12.5% only. Only benefit you get is 1.25 lakhs. So is this really a benefit? Is this really a benefit, to be honest? So it is not really a benefit. But one special benefit these 112A securities get. One special benefit these 112A securities get, this benefit is cost of acquisition. Whenever you sell these securities, and these securities have been acquired before 31st Jan 2018, if you sell any of these securities and these have been acquired before 31st Jan 2018, you get a special benefit. What special benefit you get? Sir, you get a benefit of increased cost of acquisition. What increased cost of acquisition? Sir, if you have acquired any units of business trust, equity oriented mutual fund or listed shares before 1st Feb 2018, if you have acquired them before, then you get a benefit of increased cost of acquisition. How? You have to take the actual cost of acquisition, for example, 100. You have to take the FMV as on 31st Jan. So FMV say be 400. You have to take the sales value, say 500. Provision says whatever the FMV is, or sales prices, whichever is lower you would take, that means 400. And this FMV has to be compared with cost of acquisition, whichever is higher. That means 400 would be allowed to as cost of acquisition. This is the special benefit that you get under 112. And no special benefit other apart from that. But higher cost of acquisition would be given to you. How much? You have to take FMV as on 31st Jan, sales price whichever is lower, whatever the figure turns out to be, compared to cost whichever is higher. This is the higher cost of acquisition you get in case of 112 securities. But sir, catch is, what is an FMV? What is a fair market value? Sir, fair market value is to be assessed on 31st Jan. If securities are listed as on 31st Jan 2018, if securities are listed, you have to take the highest trading price as on 31st Jan. I would request you to draw a beautiful skull here. Beautiful skull here. Why beautiful skull? Because you will forget this. It is not average price, it is not the lowest price, it is the highest trading price on the last trading session. 31st Jan, if such securities are traded, take the highest trading price. What if such securities are not traded? Take the highest trading price of the last trading session. Take the highest trading price of the last trading session. Whenever it was traded last time. Sir, what if securities are not listed on 31st Jan, but subsequently got listed? Not listed right now, but subsequently got listed. What do we do in that case? Sir, in that case, you have to take the different FMV. If you have units of mutual fund, take the net asset value, NAV. NAV, you understand? Mutual fund chapters, AFM. You have to take the NAV of the mutual funds as on 31st Jan 2018 if mutual funds are not listed. What about shares and business trust? Sir, shares and business trust, you have to take the cost of acquisition. You have to divide by CII of year of acquisition multiplied by CII of year 1718, that is 272. This will give you index cost of acquisition, and this will give you FMV. This will give you FMV. I hope you got the point that FMV is very important. FMV is very important. How do we arrive at FMV? Sir, you have to check 31st Jan 2018. If shares mutual funds are listed on that date, take the highest trading price on that day. If they are not listed, for mutual funds, you will take FMV. For shares, you would take the index cost of acquisition from the year of acquisition till the date of 1718. What is index cost of acquisition? We will discuss that. We will discuss that. We have entire topic dedicated for indexation. Mostly tomorrow or maybe today, we will discuss that. Done, sir. This was the second benefit that 112A securities get. First of all is 1.25 like basic benefit. Second benefit that the people get is this indexation, those are this FMV benefit. Sir, a small definition which is being doubted by many. What is an equity-oriented mutual fund? We have studied this twice. While we were studying period of holding, then also we studied this. Second time we are studying this when we are studying the tax rates. What is equity-oriented mutual fund? Understand, huh? If you are a mutual fund and you have 100 rupees, if you are a mutual fund and you have 100 rupees, if out of 100 rupees, 65 rupees or more are invested in domestic shares of a listed company, 65 rupees have been invested in listed equity shares of domestic company. Listed equity shares of domestic company. If 65% of your total proceeds go into listed shares of a domestic company, that means you are equity oriented mutual fund. You are equity oriented mutual fund. This definition has another leg. Most of the faculties do not have this leg in their books. Many faculties do not have. So, if you don't have, you can write it down. What second type of equity oriented mutual fund is? For example, you have 100 rupees. You are not investing in any equity shares. You are not investing, but you invest yourself in any other mutual fund. Provision says if you are a mutual fund who invest 90% of your proceeds in another mutual fund, and such mutual fund invests 90% of its total proceeds into listed equity shares of domestic company, then you are equity oriented mutual fund. Let's say again. If I have 100 rupees and I am investing 90% in a mutual fund, which is investing its 90% in listed equity shares of domestic company, then of course it is going to be equity oriented because it is investing 90%. I will also be equity oriented mutual fund because indirectly my 81% exposure is in equity only, domestic listed equity shares only. Getting it? So directly I can own 65% of listed equity shares of domestic company. Indirectly, I can invest in 90% of my money in such mutual fund who in itself invests 90% in listed equity shares of domestic company. Both the categories are considered as equity oriented mutual funds only. Got it, G? Got it, G? Got it, G? Section triple one A. What triple one A says? Before starting triple one A, there were three securities that were covered under 112A. 112A, three securities were covered. Three securities were covered. Equity shares on which STT has been paid. Equity oriented mutual fund on which STT has been paid. Business trust on which STT has been paid. If on these three securities you have paid STT and you have a long term capital gain, 112 would apply. But on these three securities, if short term capital gain happens, sir, triple one A applies. And triple one AB, how much? 20% tax rate would be applicable. If on is listed equity shares, listed equity oriented mutual funds, listed units of business trust, you have short term capital gain, you will have 20% tax rate, 20% tax rates, 20% tax rates, 20% tax rates. So till now we understood tax rates of only three securities: listed equity shares, long term 112A, short term 111A. Equity oriented mutual funds, long term 112A, short term 111A. Businesses, long term 112A, short term 111A. For all the other assets now, short term capital gain is taxed at the rate of slab rate. If you sell gold, if you sell building, if you sell any other asset, gold, building, any other asset, debt oriented mutual funds, unlisted shares, if you sell any other thing, for example, you are selling business, any other asset, if you are selling and you have short term capital gain, it is taxed at normal rate only. And if you sell any other asset and you have a long term capital gain now, you would be taxed at the rate of 12.5% as of now. You will be taxed at the rate of 12.5% as of now. Got it? Got it? Got it? These are all tax rates. Now, if up to this point, anybody of you have any doubt, just mention the doubt. Otherwise, I want 10 minutes of entire silence. Entire discussion will be based on some old things, some old facts I want to discuss, which do not prevail right now, but exist. Should I? Should I proceed? Section 112A says, 112 says, long-term capital gain on securities other than 112A is taxed at the rate of 12.5%. Yes, sir, you can proceed. You can proceed. Very simple it is. You can proceed. Sir, it is very simple. No issue. No issue whatsoever. Yes, sir, you can proceed. But this comes up with a proviso. What it says, if you are an individual or an HF who is a resident plus who transfers immovable property acquired prior to 23rd July 2024 and you have long-term capital gain. All the conditions have to be met. All the conditions have to be met. If you have long-term capital gain, you transfer immovable property, you are a resident individual, and you have acquired that property prior to 23rd July, then your tax calculation would be lower of 20% with indexation, 12.5% without indexation. What is this indexation? I'm assuming you are already aware of indexation. Otherwise, I will brief you out. I want to take an example that I have taken in my regular batch. Just let me draw that. Just give me a second to take that example. I will take that example just to make you understand. I don't think I will ever find that question. Let me draw. Let me frame it. Let me frame it for you. Let me frame it for you. This question will have impact from multiple angles. Okay? This is the example of, say, Satish. Satish acquired land in 1990s for 80,000 rupees. First, first April 2001. FMV of this property was 10 lakh. SDV of this property was 10 lakh as well. Assuming, making it simple. Satish sold this property for 60 lakh rupees and bought house of 35 lakh rupees. Okay? Okay. How would taxation take place? Computation of cap gain in hands of Satish. You would take full value of consideration. How much this house is being sold? This house is being sold on 1st April 2025. Full value of consideration is always 60 lakh rupees. Minus cost of acquisition. Sir, transfer expenses. Who will reduce? Oh, so sorry. Net consideration 60 lakh rupees. Cost of acquisition. Sir, cost of acquisition, you have to always consider actual cost or FMV. Actual cost was 80,000. But since property is acquired before 1st April, you would also have the benefit of FMV. Sir, FMV is 10 lakh rupees, whichever is higher, so your cost of acquisition would be 10 lakh. Sir, 50 lakh would be long-term capital gain. Long-term capital gain. Just tell me one thing. Just tell me one thing. One thing. Do we have to do indexation here? Right answer is clear cut no. Clear cut no. Indexation is not to be done in case of computation. For the purpose of computation, no indexation is to be done. For the purpose of computation, no indexation whatsoever is to be done. No indexation whatsoever. But sir, we have exemption as well, 54F. We have sold a piece of land and acquired property. We have sold a piece of land and acquired property. We would have indexation as well. Sorry, we would have exemption 54F. How much it would be? Long-term capital gain into cost of new asset divided by net consideration. Long-term capital gain is 50 lakh. Cost of new asset is 35 lakh. Net consideration was 60 lakh. 50 divided by 60 into 35. That means our exemption would be 29.16 and our taxable cap gain would be 20.83. Very simple. On this, tax would be charged lower of two. First option is either charge 28.83 into 12.5%. This is the first option available to us. 2.6041. This is the tax that we can pay. This is the first option that we can pay taxes. Second option, we can pay taxes as 20% with indexation. Now, whenever you calculate with indexation, you have to calculate again in the working note. How would you do that? You would do in working note as follows. Working note number 1. How? Again, full value of concession is to be taken. 60 lakh rupees. Cost of acquisition. Here now, cost of acquisition you will have to index. Cost of acquisition you have to index. 10 divided by, for 2001 was 100 multiplied by 376. That means 37.6 would be the cost of index cost of acquisition. That means your capital gain would turn out to be 37.6 minus plus 16. That means capital gain would turn out to be 22.4. Your exemption under 54F would be, sir, 22.4 into 35 lakh divided by 60. Exemption will be 13.0667. That means capital gain here in this case would be 9.33. On this capital gain, 9.33, 20% you have an option to pay. That means you have to pay lower of to 1.86667 or 260, whichever is lower you can pay, and you will pay this much amount. Did you get this point? That it is possible that your computation would be very plain vanilla. It can be very simple. But for the purpose of tax calculation, you might have to solve this question again just because of this one proviso. Just because of this one proviso, you have to solve this question again with indexation. And this indexation is only available for the purpose of tax calculation, no computation purpose, not for computation purpose. You will not get this indexation for computation, but only for the purpose of tax calculation, you would get this indexation. Did I make this point really very clear? Did I make this point really very clear what the concept of indexation is? How do we calculate capital gain in case of immovable property being transferred by individual HUF acquired before 23rd July, transferred thereafter? Did I make it clear? Anybody having any doubt? Sir, absolutely clear. Since I have got this time, I would introduce you to the indexation. Clear, sir? Absolutely understood. Now, for that matter, I want to brief you all about indexation. So one question student asks, sir, if I sell residential house property and buy residential house property, plus we can buy bonds as well, will we get 54 exemption plus 54F exemption? Both exemption can we get? Can we get exemption under 54 and 54F? Both the exemptions can we get? Of course, sir, two exemptions are allowed. Two exemptions are allowed. Sir, we sold urban agriculture land We bought urban agriculture land plus 54F bonds. Can we buy that? Of course you can buy that. Of course you can buy that. Two exemptions can exist simultaneously. Okay? This has to be borne in mind. Now, what is the concept of indexation? Since we are very close, just understand this point carefully. Second proviso to section 48. Section 48 talks about computation of capital gain. Second proviso to section 48 talks about indexation. Sir, if any asset has been transferred before 23rd July 2024, if any asset has been transferred before 23rd July 2024, in that case, cost of acquisition shall not be taken as exact cost, rather it would be indexed in case of long-term capital assets. What did I say? If asset has been transferred before 23rd July 2024, right? In the present case, will you get any question from 2024? Ideally, you will not get. Ideally, you will not get. Of course, there are few cases which I will brief out tomorrow, but ideally, you will not get any case where transfer takes place in 2024. But still, there exists a provision in income tax that if an asset is transferred before 23rd July 2024, then cost of acquisition shall be taken as index cost of acquisition. How do we index that, sir? Whatever the cost of acquisition is, divide by cost of inflation index of the year of acquisition, multiplied by the year of transfer. Sir, if you acquired that cost of acquisition in 2001, divide by 100, multiplied by 376, multiplied by year of transfer, whatever the year of transfer is, divide by year of acquisition, multiplied by year of transfer. This is the CII list, right away starting from 100. For previous year 25-26, it is available at 376. Issue involved here is, sir, what if our asset was acquired before 1st April, then what to do? If our asset was acquired before 1st April 2001, then what to do? Sir, in that case, you take cost or FMV, whichever is higher. As on 1st April, cost or FM, whichever is higher, you would take and you would divide it by 100. Because, of course, if your asset was old now, you have taken FMV as on 1st Jan. So, whatever FMV is there, we would allow indexation on that. Sir, by this way, people will try to inflate their FMV. People will try to inflate their FMV. Don't you think? Just imagine if you want to sell a house, you will increase the FMV so that your cost will be higher, your capital gain would become lower. Take a breath. Take a breath. Sir, if I am selling a property and I have an option of FMV, I will try to increase this FMV as much as possible so that my capital gain is lower. Getting it? Sir, I will try to increase this FMV to reduce my capital gain, to reduce my taxes. I will try to do that. Provision says if you have an immovable property and on such immovable property, stamp duty value is available now, your FMV cannot exceed stamp duty value. What it says, sir, for example, cost was 80,000 rupees. FMV you are claiming to be 20 lakh rupees, but stamp duty value as on 1st April is just 10 lakh rupees. Provision says you cannot claim the higher FMV. If stamp duty value is available now, maximum FMV that you can claim is stamp duty value. You cannot claim beyond that. But sir, what if stamp duty value is not available? Whatever FMV derived, then it will work. No options. So people should not be able to inflate their FMV. Now, for that matter, they are given a choice. Sorry, they have been capped to the maximum SDV. Sir, whatever improvements we have done, that shall also be indexed. But if any improvement has been done before 1st April 2001, such improvements are already considered in FMV. So improvement before 1st April 2001 are to be absolutely ignored. This is about indexation. Sir, 2 pointers. 23rd July 2024 is the cutoff date before which if any long-term capital asset was transferred, now indexation was supposed to be done on such assets. But before 23rd July also there were certain assets on which indexation was not allowed. What were those assets? Sir, listed equity shares or any securities on which 112A apply. 112A wali securities you were not supposed to index. You are not supposed to index bonds and debentures. These were never indexed even before this. Even before this, slump sale was not indexed. Even before this, any securities by NRI or non-resident are not indexed because they have a lesser tax like lesser tax benefit. So these securities were not even indexed before, and they will not be indexed after on. After on, of course, no indexation is left. But even before any asset is transferred, indexation was not available back then. Yeah, that's all from my side today. आज के लिए इतना बहुत है. Just let me go through. Just let me go through where we stand right now, so that whenever we start, we are aware of what we do. Tax rates, we are done with that. All the tax rates. Miscellaneous provisions, old and old provisions we have done. Indexation also we understood. Tomorrow, when we will come, or tomorrow or not, Monday we will come, we will understand the exemptions. We will understand some basic set of limits. We understand stock in trade converting. Sir, today is my birthday. Happy birthday, Sanket. A heartfelt happy birthday. Happy birthday. ठीक है. Old provisions we will study on Monday, and we will end up with exempt transfer. Of course, some provisos are left. We will discuss that. 1 hour, 2 hour we are left with. We will be completing that topic on Monday, and we will end up the topic. Right now, the class is not over. You have to write down daily practice question. Day 1. DPQ given in class. Question was tax calculation. Day 2. DPQ2. Question number 35, Mr. Sanjay, page number 48. DPQ2, page number 48. Question number 35, from chapter capital gain, Mr. Sanjay. This DPQ has to be done. Okay. Yesterday I gave you DPQ. Let me give a solution to that, because most of the answers were wrong. Most of the answers that we saw were wrong. At first, I thought it is in fact a difficult question. By mistake, I gave a question which was in fact not easy. But the issue is in exam, you are not going to see the easier one. Na? So you should be aware of difficult questions as well. Yesterday, I gave you a question where business income was 1.9 lakh. Dividend income was 11 lakh. Capital gain was under 112 was 1 crore. 112 was 50 lakh rupees. And capital gain 111 was 60 lakh rupees. Online gaming was 20 lakh rupees. How you are going to tax? Sir, online gaming is taxed at 30%, 6 lakh would be tax. 111A, 20%, 12 lakh would be tax. 112A minus 1.25 lakh into 12.5%, 609,375 would be tax. Of course, you might be thinking it is a bit fast, but trust me, this is a question that you would have done yourself. Okay? 1 crore, 12.5%, 12 lakh 50,000. This is the amount of tax. On this dividend and business income, your tax amount would be 58,000, 58 lakh 42,500. This is the amount of tax that you would have had. If you split it between dividend and business income, this would be the split. Simple point it is. Out of this 4.31 crore of income, 2.21 crore income is capital gain and dividend, on which 15% maximum surcharge should be applicable, and other income, 25% surcharge would apply. So on business income, we would add 25%. On other income, we would have 15%. Dividend income, we would have 15%. Cap gain 15. Cap gain 15. Capital gain 15. Online gaming 25%. Basic provision. It is basic provision. Important issue here was, sir, do we have concept of marginal relief coming in this case? Is there any chance that we can have marginal relief coming in this case? Is there any chance? Sir, think of it that way. Our 2.21 lakh income was tax surcharged at 15%. Our 2.1 crore was the income which was surcharged at 15%. Correct? Think of it, try to process it. 2.1 crore was the amount of income on which surcharge applicable was 25%. Even if we try to lower this, even if we want lower surcharge benefit, even if we charge 15% surcharge benefit, for that we have to forego 10 lakh worth of income. We have to surrender 10 lakh rupees not to government. Are you getting this point? If we want lower surcharge benefit, we had to surrender 10 lakh rupees worth of income now. Do you think 10 lakh worth of income would be any way beneficial? Surrendering 10 lakh would be never beneficial. Yeah, never 10 benefit of 10 lakh is never allowed. You never get a benefit 10 lakh. Na? Try understanding this. Try understanding this. Huh? You can never get a benefit of surrendering 10 lakh rupees. So therefore, surrendering would not make any sense. Therefore, surcharge would not be marginal relief would not be applicable in this case. I have tried doing that with marginal relief also. Benefit was not subsequent. Benefit was 6 to 7 lakh only. Benefit was 6 to 7 lakh only. Whereas paying taxes under 25% was more beneficial than to forego the upcoming 10 lakh. Okay? So in this case, marginal relief is not required to be calculated. No marginal relief concept would apply. Okay? That's all from my side today. That Sanjay question is to be solved mandatorily. If you like the session, do think of liking the video. Comment down your experience on yesterday's lecture and today's lecture. Capital gain is almost done from my end. Only few topics are left. Few topics as an exempt transfer is left. Apart from that, some important topic that is exceptions to 45(1) is left. Apart from that, capital gain is done from my end. How did you like capital gain? How was the speed? How was the gesture? How was the examples? How was the depth? Everything. If you have any view now, do share it with me. If you have any doubt in income tax, also share it with me, because this is the way we are going to solve. Of course, some topics are going to be more interesting, some topics are going to be less interesting, but the pace will remain the same. Today was very power packed session. Very power packed session. We had a lot of knowledge being thrown up, and I am very proud of you all that you have been able to sit for this long. Normally this long sessions people are not able to sit. If I can see absolutely 24 hours you all have been seated for absolute 4 hours, and this is not easy at all. This is not easy at all. So kudos to your efforts, kudos to your dedication. It really means a lot to me for people who sit for this long. So it was a great time. If you have any doubt, I'm always there. If you have not enrolled for the batch, do consider enrolling, because the more early you enroll, the more early access you will be provided to access to the batch. Now, the issue is I ordered your concept book on 2nd Feb, but yesterday I messaged the team. They told they are going to be dispatched. Will it take more days? Ideally, they should not take. Just message me today with your name and order ID. I will take the मैं उनकी खबर लूंगा at least exactly what went wrong. See, sometimes what happens when they send to the courier company, they get returned. Sometimes you live at a place where courier companies are not accessible. There are many issues. Ideally, they don't do this long. They don't do this delay. But there must be some issue at the courier company. I will get that settled. You don't have to worry about it at all. When you come to me now, I give you this privilege that every content that you require, I provide. Question bank is available. Concept notes are encrypted format is available. Everything that you require, I am also available to any time. So you won't require anything. But still, of course, these things are to be addressed. Otherwise, normally this is not what is faced. And in addition, I would tell you one thing. I always keep 5 lectures of our batch on YouTube, because I know other faculties would also come up with power batch. There would be orders of other faculties as well. So let others fulfill. I am okay to be at last, because I know my students. I provide this much support na ki even if they receive 1 or 2 days late na, they are okay with DT. So I hope you also understand that. Don't worry at all. Everything that you require will be given to you. This is a small issue. Okay? Receiving books late, receiving concept book late, receiving these two things are a smaller issue. Focus on the bigger issue. Are you able to understand with the class? Are you able to solve questions? That is what matters the most. Now, the DPQ that I have sent you is a beautiful DPQ. Okay? Try answering that. Believe me, Yesterday, everybody was energetic. Most of the students from the class sent me DPQ. Almost all of them were wrong. Almost all of them, except for a few, all were wrong. Today, I expect the same because people start with so much enthusiasm, but enthusiasm fades away. To be honest, do share PPQs today as well. This is what is going to be the best thing that you can ever experience in your DT. The DPQs, not the class, not the question answers, not the examples, not the sitting, but the DPQs. Okay? See you all on Monday. Bye bye. Take care. Till then, have a great weekend. Have a great time studying.